Good morning, everybody, and welcome to the Team Europe Borrowers event that we're happy to host today. We have, as you'll see, a lot of people in the room today. We have 7 issuers representing 1.3 trillion euro of annual issuance, we believe, calculations that ONFIF did. So an important group of people at a time where managing debt and raising debt is as important as it's ever been. When we launched the Sovereign Debt Institute about 18 months ago, 2 things were happening. One, NGEU was launching. We thought that was an important moment for the market. We also thought that we might have some sort of return to normality. But normality seems to be an elusive beast these days. And I'm sure today we're going to discuss in depth a lot of the issues in the market. Markets are clearly difficult right now. The challenge facing DMOs doesn't grow smaller. It seems to grow larger. We have the obviously rising interest rates. We have the difficulty of finding issuance windows. We're represented today with a number of investors, both in the room and a lot of them joining us online. We have about 200 people joining us online, many of them big asset managers, reserves managers, global public pension funds, who I'm sure will be very interested to hear the plans and the views of the borrowers and the investors sat around the table today. We'll talk about the advent of NGEU and its impact on the market. We'll talk obviously about the changing rates environment. We'll talk a lot, I think, about liquidity as well, about the windows of issuance, and we'll make sure not to underestimate the job that the DMOs have in these markets. I think one of the qualities that I find of DMOs is they are largely an unflappable group of people, which at times I think in the last 10 or 15 years they have needed to be. We're going to start in a minute with a presentation from the Luxembourg Stock Exchange, but before we do so, just a couple of things for the speakers. When you speak, so that everybody listening in online can hear you, please press the little icon on the microphone in front of you, and when it glows red, that means the world can hear what you're saying. I would like to thank our partners here today, DZ Bank. Frank, thank you very much indeed for your support of today's event. Also, Luxembourg for Finance. Nicholas, thank you very much for your support of the event. It's great to work with both of you, your long-time supporters of ONFIF, and it's great to have you here. And thank you for your support. So I'm going to now ask to kick us off, Julie Becker, who is the CEO of the Luxembourg Stock Exchange.
Thank you very much, Clay. Ladies and gentlemen, good morning. I'm very happy to take part of this seminar today dedicated to supranational and sovereign issuers. It's a privilege to get a place at this table, so to speak, when some of Europe's leading issuers, when they come together to discuss the current state of Europe's debt markets. I look so forward to learning more about the strategies that some of Europe's most prominent issuers are considering or even already implementing in the current economic context. A context, as we know, marked by record inflation, rising interest rates, and geopolitical uncertainty. And I'm confident the next couple of hours will be insightful and relevant for us all. As the world's leading venue for international debt securities, the Luxembourg Stock Exchange is serving 2,000 issuers from more than 100 countries. We have a long and interesting story with supranational, sovereign, and agency issuers. And we currently serve as a listing venue for 115 sovereign and quasi-sovereign and 16 supranationals. So it will come as no surprise when I say that I'm surrounded today by some of our leading issuers. The Luxembourg Stock Exchange is a chosen listing venue for Team Europe, meaning the European Commission, EIB, and ESM. And we also serve as a listing venue for KfW, DZ Bank, and the Republic of Italy. Our work with supranational and sovereign issuers has only grown in importance after we established the Luxembourg Green Exchange, or LGX, in 2016. LGX is a platform dedicated exclusively to sustainable finance instruments, and it encompasses today 1,500 green, social, sustainability, and sustainability-linked bonds, many of which are issued by the issuers present today around the table. But let's go back to Team Europe, which is a leitmotif of today's seminar. First of all, I would like to state that the Luxembourg Stock Exchange is an avid supporter of Team Europe and the leading borrowers that form part of it. In a certain sense, we even consider ourselves being part of Team Europe, We are extremely proud to be able to play a part in the European Union's historic bond issuances. The EU's recent bond issuances have no doubt brought a real boost to European capital markets. They position the EU as a leading player in international capital markets, and they strengthened the international role of the euro. Despite, or maybe should I say because of the challenging economic context, capital markets have an essential role to play. The mission of capital markets is to make capital available to fund projects and companies that support the real economy and provide an alternative to bank financing. Capital markets serve to mobilize capital and channel these capital flows into investments that contribute to growth and prosperity in Europe. Capital markets help companies grow, invest, and create jobs, and moreover, foster more needed innovation. Market financing make it possible for governments to deal with crises and invest in the well-being of their citizens. Stock exchanges were created exactly for that purpose, to act as a meeting place between people, companies, and institutions that need money on the one hand and investors that have money. Exchanges provide access to market financing and help unlock untapped pools of money that can be invested in projects and companies that create benefits for the real economy and for the society overall. Europe's capital markets have a very interesting history, one that has shaped and influenced our exchange over 90 years. Since the first Eurobond was issued and listed on the Luxembourg Stock Exchange almost 60 years ago, an anniversary that we'll celebrate soon. Europe has transformed and strengthened its capital market activity. The Eurobond provided Europe with a very deep, liquid, and attractive fixed income capital market structure. It served the needs of both issuers and investors and contributed to placing Europe on the map of international capital markets. Then the introduction of the euro in 1999 was another catalyst that significantly increased cross-border activity across the continent, fueling growth and boosting liquidity in debt capital markets. Important investments followed to eliminate frictions in cash and security movements between European counterparties. And the result is that a French investor can now trade a German bond with a Dutch counterpart almost as seamlessly as it was a purely domestic transaction. European multilateral development banks, such as EBRD and EIB, and other supranational bodies, such as ESM, have played also a crucial role in pioneering capital markets development and therefore contributing to growth and prosperity in Europe. Since the financial crisis, we have seen a steep increase in regulatory developments and requirements. The objective, of course, is to create more robust and resilient capital markets in Europe. Investor protection has been brought center stage. This is very important. But investor protection cannot work without financial literacy, and going forward, it will be essential to increase efforts in this field. European citizens are still keeping most of their savings on their bank accounts. A recent study published by the Bankers Association here in Luxembourg suggests that in Luxembourg, 80% of people's capital sits on current accounts and saving accounts. Even in a country where the financial sector makes up an important part of the GDP and a significant part of the population is working in banks and financial services, people are not putting their money to work for the economy. This is something we clearly need to change. We need to create an investment culture in Europe if we are to strengthen Europe's capital markets and Europe overall. Because if we are to reach our global goals, as defined by the UN SDG and the Paris Climate Agreement, we will need to mobilize massive amounts of private capitals and channel these capital flows into projects and companies that contribute to positive social and green outcomes. Public money will not be enough. And I think this was clearly repeated many times 2 weeks ago in Washington, DC. We need to increase the awareness among European citizens of the role they play in contributing to creating sustainable and inclusive growth in our region. This brings me to sustainable finance which is a topic close to my heart and high on the agenda of many issuers present in the room today. I'm sure we will be talking a lot about next generation EU in this seminar, but let's not forget that the EU sustainable debt issuance started before that. And it started with social bonds, not green. In 2020, remember, when the COVID-19 pandemic was still front and center, the European Union issued its very first social bond under the EU share program. These social bonds raised funding to protect jobs and workers across Europe at a time when many sectors had ground to a halt due to the COVID-19 pandemic. In total, the EU has issued 90 billion euro worth of social bonds under EU share, all of which are listed on our exchange. The first of these bonds, a 17 billion euro issuance, was 13 times oversubscribed. This goes to show the massive investor response to the EU sustainable funding program. Then in June last year, the EU issued its first bond under the Next Generation EU Recovery Instrument. It was a 20 billion euro bond, the largest institutional single tranche euro-denominated bond ever issued. And it's also listed on our exchange. A new record was set a few months later when the EU issued its first green bond under Next Generation EU. 12 billion euro green bond, which is the largest green bond ever issued at the time of issuance, even though the bond was 7 times oversubscribed. This is really impressive. This bond issuance illustrates how the EU has leveraged capital markets to respond to different crises and thereby protect its citizens and European economies alike. But it does not stop with the European Union, of course. In September, we celebrated on our exchange KfW's milestone of reaching earlier in 2021, 50 billion euro in total green bond issuance since 2014. This is truly impressive as well. And in May last year, we reached the 1,000 sustainable bonds mark on the Luxembourg Green Exchange. And the 1,000 bond was none other than a $1.5 billion global climate awareness bond issued by EIB, which is one of our very frequent issuers. So the EU, EIB, and KfW and other leading issuers of sustainable debt instruments have played and continue to play a crucial role in making capital markets more sustainable and inclusive. Europe is in the driving seat of sustainable finance and home of a sustainable debt market that still flourishes despite the challenging market context. So to conclude, where are we heading? On the one hand, more digital capital markets, which leverage new technologies such as DLT, will make markets more efficient and open new opportunities for people. On the other hand, the transition towards more inclusive and sustainable economies will only accelerate. And this involves mobilizing massive amounts of private capital. Capital markets are at the heart of this dual green and digital transition and play a key role in securing growth and prosperity in Europe. I'm sure that many of those present around the table in this room and those watching online will contribute greatly to these efforts. Thank you very much.
Julie, thank you very much for those opening remarks and for setting the scene for today's discussions. It certainly feels right to be here in Luxembourg today. It certainly feels to be at the heart of Team Europe. Congratulations on many of the achievements of the Luxembourg Stock Exchange that you outlined. I wonder whether today we're going to talk a little bit about whether some of those eye-popping oversubscription numbers might be a thing of the past in current market conditions. But on that note, I'm going to hand over now to my colleague Burhan Kadbay, who's the head of content for the Sovereign Debt Institute. Burhan, you're going to host our first panel. Over to you.
Okay, yeah, thanks, Clive, and thanks, Julie, for a great keynote and a great segue into the first panel. So the first session of the day, we're looking at Europe as an issuer, the lessons learned and the next steps forward. We'll be looking at how the EU has evolved since becoming a frequent large issuer in the capital markets, what impact that has had on other large supranationals and agencies, and how these issuers have been navigating the volatility in the markets. So the first panel, we've got Sandeep Dhawan from the European Investment Bank, head of benchmark funding, Christian Engelen, head of borrowing and lending at the European Commission, Frank Scheidig, global head of senior executive banking at DZ Bank. And in this hybrid world, we've got two panelists joining virtually, Casper Hense, partner and senior portfolio manager at Blue Bay, and Sven Warbles, head of public funding at KfW. So to kick things off, I'll start with you, Christian. It's been 2 years since the EU has been a large issuer in the capital markets. Maybe you can talk about the journey, the lessons learned, and sort of where you are now.
Yes, good morning, first of all, and thank you very much. Very happy to share a few thoughts on that, although I must say that Julie Becker has already mentioned most of the really really important milestones in that regard. But let me share a few thoughts from my perspective. It has been a very remarkable journey over the last 2 years, and Julie mentioned it did not only start with Next Generation EU. It started already with SURE, almost 2 years as of now, when we issued the first social bond under the SURE program. And then as of summer last year, we continued with the implementation of Next Generation EU. Next Generation EU is a very remarkable step forward for the EU, but also for Europe in general. And that's not only because of the sheer size and the financial impact that has in our issuance world, but rather what this reflects. It is a program which is a very clear commitment from member states that they wanted to address the needs that emerge from the COVID pandemic together in a united way at the European level. And that was the first time that member states acknowledged that there is a need for further integration and for showing more political cohesion in the way how they implement economic and financial policies. And that's the real game changer behind it. Apart from all the metrics that are now breaking records or have broken records, I think the important point, and that was also what was acknowledged, is the broader integration that this shows. And maybe also to share something, and I see that we have here colleagues from Moody's in the room. It was very positive to see that also the rating agencies actually considered Next Generation EU as something as credit positive for both the European level and the member states itself, because of this cohesion that was reflected in it. So I think it's worth noting that it was a real game changer, but not only because of the capital market component, but rather because of the broader integration steps that are reflected in it. But beyond the political integration story, there's also an operational implementation need, and that was what was challenging for us in the European Commission to make this work. We have changed very much our approach of issuance. We have undergone a very significant transition process by which we have emerged from becoming a ad hoc issuer for smaller, very confined programs to what we would call a sovereign style issuer, where we broadened out the instruments of issuance, the techniques of issuance. We have launched a short-term borrowing program. We have established auctions as a way to issue, but also to structure our issuance in a more diversified manner. So we now issue with a continuous supply across all maturities in a transparent and predictable way. And that is what I would qualify as the sovereign style issuance, where investors know what to expect from us and also have a broad menu of transactions to choose from. And we hope that this will facilitate the adaptation of the market also to us as a new big issuer coming to the market. The metrics of our initial deals were already mentioned with the oversubscription, which indeed showed a lot of interest and a lot of support from the investors we have received so far. And we will do everything we can to maintain that support and to deepen and broaden it. It is, of course, not yet done. We are still in the middle of this transition process, so there's still some way to go. certainly, when we look at liquidity of our bonds in the market, when we look at also how the market basically treats us, there are still steps still to be gone, but I think we have made quite a good leeway. So overall, quite a positive experience, not without its challenges, but I think overall we have succeeded so far.
Yeah, thanks, Christian. We'll go on to the sort of the EU's status as a sovereign borrower a bit later on, but maybe Frank, I'll turn to you. What impact has the arrival of the EU had on liquidity and interest in the wider SSA bond market?
Yeah, first of all, great thanks to OMFIF and our partners here in Luxembourg. It's wonderful to be back, and I have to say, Luxembourg to me is probably the most efficient financial hub we have in core Europe. Having said that, yeah, coming back to your question, obviously the liquidity situation, thanks to my partner on the left, Tamodima, who has made a coup last year, and an announcement has differed in comparison to what we have seen the weeks before, where spreads also widen quite a lot. I think in general, this should disappear, in particular over the next year. Why is it so? Because people will fly back to quality. And you have said it, Christian, with the EU, we have, don't forget, the largest issuer, meanwhile, on sustainable bonds, in particular under the SURE program, if it comes up to social issuance, and also the 30% of the overall 800 billion in next generation EU program. I see also a profit for other sovereigns. Why do I say other sovereigns? Because we see the EU more in the camp as a, well, you can't say just sovereign, it's a multi-sovereign to our personal opinion. Surely you can accept the discussions. It would be nice to see them as a permanent issuer, but this belongs to our politicians in Europe. I hope they have seen the chances which come along with it, and you have to have the expectation to put them in the camp as a sovereign issuer, that there's more to come as the current programs we have seen. But to my personal opinion, this is a great chance as well in times where we also face facts that investors go more back in their own territory, in their own currency blocks. So typically people, huge accounts who are based in Europe go back into the euro issues, similar quite into the dollars, even they have still the favor as being the only global world currency being used for the factoring of or the pricing of factoring of real economy flows. I would like to come back to that later on if we can shift towards this direction, because the potential of the euro and its quality issuers, like the sovereigns we have seen in Europe so far for many, many years, and if I may say so, Christian, without letting it sound disrespectful, the new kid on the block, the giant EU. And having said that, at the same time, we have the KfW on the screen here, as well as European Investment Bank, very well known, and surely on my right on my left, several sovereign issuers like Tamodima here from the German side, and as well as the Dutch and the Italian and Luxembourgish sovereigns. But having said that, this combined gives us all so much liquidity, and the euro should be seen definitely as a serious, severe alternative. But what we would need, as well as in the credits here, that the banks, the system provides, including the American banks, provides more and deeper liquidity in derivatives. So, and then the euro would get a different chance, and we hopefully will release a swap reference rate instead of 11.15 at 9 o'clock, so that Asian accounts would be able to use that as a pricing tool and obviously as a liquidity pool, as long as the liquidity is provided in derivatives. That would bring the euro as a very first alternative to the US dollar. And then those sovereigns who sit here right now, others who are not sitting here, and also the EU would definitely have a more tightening story to say in the coming years. Thank you.
Yeah, thanks, Frank. I'll turn to you, Sandeep, then. So has the EIB benefited from the EU's arrival? Have you seen more interest in EIB as a result of the EU's arrival as a large issuer?
Thanks, Murat. May I also begin by thanking OFFET for organizing this event, organizing it in Luxembourg, more importantly, and for inviting EIB. Coming to your question, I think there's two ways to look at it. At a macro level, there's no arguing that the lack of a composite common euro-denominated risk-free asset has held the currency back from finding an appropriate weight in global finance. And although that's not changed, the issuance of debt on a grand scale by the EU is certainly a step in the formation or the creation of such an asset. Having said that, there is no denying that at the start of the process, as Christian pointed out some 2 years ago, there were some apprehensions about on a number of parameters, such as whether the market would be able to absorb this size of debt easily. Clearly, those concerns haven't materialized. In fact, demand grew to meet supply. And if anything, the EU has, I would argue, not just expanded the market, but energized what was already quite a mature market. Clearly, we had concerns about our funding costs being dragged wider in order to absorb such a vast quantity of supply. Those concerns haven't come to pass either. Indeed, EU is often traded through EIB. And whilst we can debate the merits of that, what is true is that funding spreads have not been dragged wider. Thirdly, EU issuance or euro issuance calendars have always been busy. And the addition of a large-scale regular supplier was always going to lead to some degree of congestion. Having said that, again, from EIB's perspective, we don't have a prescriptive issuance calendar whilst trying to remain reasonably predictive. We haven't found it very onerous to try and access markets to complete our funding programs either. So even though there is a bit of congestion at various times, the congestion is seasonal and you can navigate it reasonably easily. We also had some degree of concerns at the start of the process as to how dealer balance sheets would skew towards the largest fee provider in the market. And to some extent, you could argue that did come to pass. But again, we haven't seen, as a consequence of that, any lack of appetite for underwriting or distributing EIB debt or indeed trading EIB debt. And as Frank has alluded to, EU debt is not just traded off SSA trading desks anymore. A lot of it's traded off EGB trading desks. To the extent that capital was going to be diverted or skewed towards the EU hasn't quite happened. So again, we've been pretty comfortable in what we've observed. Last but not least, we did think or suspect that QE flows would adjust towards new supply, and that is as it should be. But sitting today with QE having been dialed down substantially and coming towards an end, it's a moot point. So on all of these parameters, I think we can make a pretty good case that the market has absorbed the sort of supersizing of the EU in the last 2 years, as well as could be hoped for. And I think the credit for that, without doubt, should be laid at the doorstep of the Commission in how well they've managed that process. As far as the EIB is concerned, we haven't needed, or there had been no requirement on our side to either change or shift any strategic or tactical way in which we approach the market as a consequence of the EU entering our market. We are a relatively small multi-currency investor diversification platform issuer. And our funding programs have continued apace. This year, we have already finished over 95% of our funding program. I'll make one last observation, which is that Luxembourg has seen the growth of EU debt issuance institutions, EU, ESM, EFSF, EIB. Sometimes these institutions are often called lazily, in my view, as e-names, and are frequently traded in a relatively highly correlated way. What that sort of says to me is that the fortunes of one will impact those of the other, or the misfortunes, I want to call it, one way or the other. In other words, the destinies of these institutions in financial markets are now getting ever more closely linked. And that's an interesting thing to watch. And I'll end there. Thank you.
Thanks, Sandeep. I'll turn to you, Sven. Do you sort of agree with what Sandeep's comments there, that there's been strong coordination between the EU and the other large issuers? And have you seen any sort of benefit in KfW's bonds from the EU's arrival?
Yes, good morning from Frankfurt. And it's an honor to speak up here for KfW. So thanks for inviting us. I fully agree to what Sandeep said. So first, what I would like to emphasize is that I have to say that with the European Union as an issuer, we have something, we have someone at our side who shares in a way the same vision. So it's about the same ambition. It's about promoting Europe. It's about promoting societies, promoting the next generation, I would say. So overall, the Euro market, in my opinion, has benefited. The Euro as EU as an issuer, for me, brought additional attention to the Eurozone. So there was more spot on the euro as currency for investors. We as KfW, we saw new investors, which we hadn't seen before. And actually the number and the variety of investors in KfW's bonds increased. What we also saw and experienced was, in some regard, the EU's arrival was challenging, of course, to us, and that is about potential windows of issuing bonds, because especially between the disclosure of EU RFPs and the execution, the attention in the market is spotted really on the EU. So that might limit, in a way, our ambitions at the same time. So I would say, in addition to the syndicated transaction, we saw also the EU auctions, which limited, in a way, our windows of opportunities. But anyway, it's always challenging, and it has not hindered KfW to increase its funding volume during the last years. So as Sandeep said, there was more supply, but it hasn't hindered KfW to fund its ambitions and its volume. So overall, we have a positive view on the EU's arrival in the market.
Yeah, thanks, Sven. Maybe Casper, from an investor's perspective, just drawing on those comments, why do you think there's been no distortion and rather an increased appetite in European SSA bonds, particularly the liquid names?
Thanks for the invitation. Both agree with what the other persons have said, that there hasn't been any difference in issuance, but there has been some distortion on other names, EFSF and ESM, but they have been in a context rather minor. I think the distortions which have arisen rather coming from a general pricing of risk globally. But on the other hand, we also would say that had hoped years ago that the EU bonds would become something closer to the next free risk-free assets of European financial markets, as highlighted. And we thought it could be the next big step for capital market union. This hope has not been fulfilled so far. We would see, in general, it seems to still the risky assets. European swaps spreads are still bonds versus swap rates, and the collateral of choice is still bonds despite capacity. So that is obviously most the political discussion. We can't really change to a large extent. What we think, especially in this time, would help would be a larger footprint in the front end of the curve, especially now where there's not only AAA bilateral demand very high, but also investors in general are shying away from duration uncertainty around the inflation outlook. And we don't only see that in Europe, we see that for the where demand for treasury long and cash bonds is there. So all the swap spreads are very negative and are not really demanded. Would like a bit more flexibility from really in that. So we applauded what the Bundesfinanzagentur has done with the latest repo issuance. And in that regard, we think it makes complete sense, like the KfW has done 3-year issuance, but not bringing long-end issuance. What we see in financial markets is that 50% of government debt is roughly in bond, and that is true for the US, but also for European government bonds. But the EU has a 15% front end. And we think there is a shortage of collateral, which also the EU could. And with that, the EU bills, the EUBs, the ESMTBs, so the ESM bills, that market seem to be underdeveloped and also not marketing well enough in our view.
Okay, thanks, Caspar. Just apologies to our virtual audience. I think the feed was breaking up a little bit there with Caspar, but hopefully that is a bit clearer later on. We'll just move the discussion now. Something that Christian, you mentioned about the EU moving to a sovereign style issuer. Is that the aim for the EU, to be seen unanimously as a sovereign rather than a quasi-sovereign or a supra?
I think that's a very, very important question. We surely would like that the market is treating us as a sovereign. Whether we are seen as a sovereign or not is a different question, and probably more political nature. But I think what is clear is, and Sandeep has pointed to that, the market is treating all the European or EU-related issuers in the same way, and not differentiate, or not giving a lot of effort in differentiating and understanding the specificities. And I think this is also something we experience. We are an institution which is not organized in a corporate way. We don't have a balance sheet we finance. We are more set up on a budgetary framework, which is more resembling the structure of sovereigns. We are a jurisdiction. We have, member states have conferred legislative and sovereign powers to the EU level. So it's not that we are an international financial institution like others out there. And that is something the market is not acknowledging so much in the way how they regard us and how they classify us. And also, given the way how we now have structured our issuance, we would hope that the market over time follows us in treating us as a sovereign style issuer, and that would also imply that they are treating us more in the way how EGBs are treated in terms of trading, in terms of investment limits, etc. pp. But we know that this is a gradual process. This doesn't go from one day to the next. It's just that we would like to see that the transition is not losing momentum. That is, I think, the most important point from our perspective. And I would just like to add one thought, and sorry for taking longer, but I think it is important to understand that indeed what we are seeing is, and it's very good to hear also from the other institutions, that there's no crowding out effect on the European SSA market, where investors now see European SSAs as an interesting alternative to invest maybe in a more diversified, still high liquid asset. And that's, I think, the only way how we will achieve European financial integration over time. So it will not be the big bang that, we come from a fragmented market and then the next day we wake up and we're in a fully integrated market. It is a step-by-step process. And I think what we have now seen with the establishment of the institutions, the establishment or the maturing of the SSA market, and now taking that a step forward with Next Generation EU and using that segment also to place such a program and to implement that like Next Generation EU are very important steps in that regard. And I think we are making a lot of advancement on that. And that is what I hope that investors also see. And they see that this is something where this is not the end of the road yet. So we will not, stop with that. And that's the largest integration moment we will have. So I think that is clear, but it is a process which takes time and goes probably in steps and not with a big bang.
Yeah, thanks, Christian. Yeah, sort of a journey, and that takes steps. Frank, I'll turn to you. How do you view the EU? A sovereign, a quasi-sovereign, and I suppose how do you define a sovereign? Is there a sort of definition that you need to meet or criteria?
Well, first of all, you can't ignore the techniques and the main investor or one of the main investor base, which are the asset managers and funds. And most of them seen them still as a SSA because given the current mandates then, yes, and not being present in one of the indices, so which has been used for benchmarking. That might change in the future, but again, I'm not a politician. I can't foresee things. We as a bank, we try to push more in a corner of, as I said, in something which doesn't exist officially, which is a so-called multi-sovereign issuer, which is one of its kind and the only one in that dimension. To my personal opinion, if we ever want to have, and this is not politics, this is market facts. If we have larger markets, deeper liquidity, a whole curve, and we heard it, from build up to super long, and I can't remember of any of those issues which was not tradable over the past years since the EU exists in such a dimension. This is exactly what we need as a counterweight to the dollar, to the US dollar. And if this is growing in our minds, I do hope that the politicians don't ignore what is a fact that most of our sovereign members in the EU, they have a way higher cost of funding. And through the EU, they would get a cheaper funding. And the side effect is that if we get these providing of further liquidity, it would all run in our favor because we are a true alternative then to the US dollar bloc. I know that it is nice to hold on to jobs and all of that. It comes down to a very personal level then, but very dryly speaking, should be what we should aim for then and support that at least up to a certain degree. That would be my call then.
Yeah, thanks, Frank. I'll turn to you, Casper. I mean, I guess firstly, a question to you: how do you view the EU? A sovereign, a quasi-sovereign, or a super, and do you think the EU can sort of develop a futures market now, or does it need more liquidity?
Yeah, I hope you can do that. I try to speak as closely to the microphone as possible. In our view, we trade like a supranational, but what we think really important if it put into the index inclusion for government/treasuries. So a reading of that would be a good thing in view. I think it is possible in the current framework of the euro that it should be classified as that, and we are pushing for that at index councils, that it be part of the government benchmarks, which are roughly 50% what sovereign benchmarks are made out of. It would be very important to get a natural investor base. And I think we should push for in general. About futures market certainly would help a lot. Then you could trade also futures, which more market participants use in a way. And also then the framework might be a bit closer, more solid to the US one, where maybe you don't have a future on Puerto Rico or California, but maybe you rather trade via the government spectrum.
Okay, thanks, Casper. Just turn back to you, Frank. I mean, what benefits are there? I think Casper touched on a few things there, provisioning for sovereign indices for the EU to be included in some of those. What benefits will there be for the EU? I think you touched on a little bit there about for it to be classified as a sovereign.
As I mentioned before, I do expect definitely a spread tightening, clearly from where we are right now, but that indirect will also help the other sovereigns, or the sovereigns, sorry to say so, who are members of the EUs and in particular of the euro, to price themselves also tighter in markets. Yes, but I do expect, as I said, a higher, even higher liquidity, and who knows what the ECB will do over the next 2-3 years, if there is a chance, if they're going to release parts of their portfolio in a very healthy way, because more and more demand is coming, because this is what I also foresee. If the euro will become into a different status, and as I said, in a combination, having the EU as such a massive permanent issuer, then in case it happen, our currency will also become a different kind of, and as I said, if we provide liquidity as financial market members in the derivative markets, it will help all of us, and particularly those who are not based here, Asia Pacific, in that time zone will definitely use the euro completely differently as they do it right now, because don't forget, the US swap rate is 2 days old when they come in the morning, and they have to use it as a reference for their real economy trades when they're factoring it in dollars. And here, the euro, if as I said it before, if the euro reference rate will be released latest by 9 o'clock, we will provide at least another 2 to 3 hours to most of the Asian Pacific countries. And as I said, the whole euro bloc, including those currencies who are still on its own, like sterling and who are pricing through the euro, will become a different animal. And we make it as a time zone cheaper to fund ourselves. Yeah, this is what I predict.
Yeah, thanks, Frank. I guess you mentioned a key point there that one thing that the EU needs to become a sovereign is permanent issuance. So, I mean, Christian, what can you say? Will the EU be around for a long time as an issuer? Obviously, it'll be funding the NGU and refinancing that. But beyond that, what can you say? Do you think the EU will be around after that, funding other crises and causes?
I can certainly guarantee that we will be around until 2058. Whether you qualify that as long term or not, I leave that to you. That's the duration of the Next Generation EU funding that we have to implement, and we will be there as an issuer even after the implementation phase. I think what is very clear, and it's not for me to speculate about new programs or not, but I think what we should acknowledge is that Next Generation EU was a test case, and it was also the idea of trying out whether we could establish some kind of a treasury capacity at the EU level. And I think so far, as we have heard so far also today, we are succeeding in that project. And the more we succeed, the more it becomes appealing also as a leverage for possibly future policy programs. But that is not for us to decide or to promote here. It's just that I think we show clearly that there is a case, there is an appetite in the market. I think the support and the investor demand we've seen in the transactions confirms that there is really a lot of latent interest out there. And the question is, do we want to lift that potential or not? And I think here, what we discuss here are very important steps to continue on that path. I think what Casper said about index inclusion is one of the really crucial next steps to give investors also the ability to build that or to fully integrate that and accommodate that in their investment strategies and how the market sees and trades us. And the more we go down that route, I think the more it becomes tempting also for policymakers to have a look at how finance can help for policy implementation.
I mean, there's been a lot of speculation about the funding the energy crisis. Is there anything you can say about that? Has there been talks about creating a sort of separate fund to fund that?
I can't talk about that because I'm not part of these discussions. I know that there are a lot of reflections within the EU institutions and outside the EU institutions, but I think it shows one thing very clearly: the energy crisis is yet another crisis situation which comes upon us out of the blue, and it is one which is hardly solvable at the national level. It requires a European response in the same way as the economic damage through the COVID pandemic needed a European response, in the same way as the climate transition requires a European approach. So these are all crisis layers that we are facing, which will hardly be, as I said, solvable at the national level. And I think that's the acknowledgement member states go through step by step, indicating that they see these as European problems, which they have to address collectively and not individually. And if they want to design policies to address that, it may be that financial leverage and capital markets are a tool to implement these policies.
Okay, thanks, Christian. I'll just turn to you, Casper, again. From an investor's perspective, is there more increasing appetite for more joint EU debt?
Certainly there is that benchmark inclusion be helpful, and right now, and we don't know when that is changing, cash is king. What does that mean? That there is high demand for collateral, there is high for the triple A's, but we also again would say the main will be for in the front end and to establish
Berhan, I wonder if I might quickly bring Patrick in for another investor view. Obviously, Patrick of Neuberger Berman, a global investment firm, but with a US parentage. Have US investors been more interested in Eurozone debt because of recent developments? And equally, that same question, where does NGEU sit in your investment bucket? Where does it go in the portfolio?
Of course, I would like to highlight the different explanations that the market conditions were quite important. I mean, the negative rates, the very low rates, mean to be clear that US investors didn't have a look clearly on the Eurobond, especially sub-sovereign and sovereign, but also even the high credit quality. Of course, the market is looking for diversification and for high quality issuers. And so to come back to the discussion, US investors are looking for high quality debt, and European Union, different type of issuance could match their needs. But currently, of course, the market conditions were a bit an issue. If you take into account the cross currency swap, they are really not, they are painful for the Eurobonds for the time being. Of course, it depends on the ECB. If ECB hike more, it should mean that long bonds should be interesting. So the global investors are also looking for the liquidity. And perhaps it should be our next step, next discussion. The liquidity relatively was not bad. And of course, from the long-term perspective, I would like to say that the credit analysis is quite important. And when you look from the US, but also we have a large array of clients in Japan, the knowledge of issuers of the Eurozone is something different, as you can expect, because there are so many public names. And the history of the public names is not necessarily very positive, except EIB, which is well known in the world. Other public names, especially in France, in Italy, is boring. It's complex to analyze all these issuers. So for me, the tailor-made, to have less issuers, perhaps, different names, as you mentioned, is a bit too complex for US or Japanese investors. Of course, this is my job to promote and to invest for these investors. But of course, it's taking time, to be clear with you. And of course, the quality of the debt is important, and the lack of good quality debt is really a question in the world.
So one of the positives of rising rates is actually, it means that moving into positive territory, more global investors will be interested in Eurozone assets.
Of course. It's too early, it's too quick. We have to perhaps to stabilize the sell-off first. But yes, I expect the European Union should be a key investment for many issuers in the world. But don't forget the history. The Eurozone is complex for when you're outside.
Yeah, thanks, Patrick. Just moving on to talking about the current state of the market. Maybe Frank, you can give us a sort of picture of the current market conditions for SSA borrowers. It looks like it's getting increasingly difficult for SSAs. Or, how would you describe the current market conditions?
Well, given the current or over the past weeks, high volatility, and we should not forget where we come from then. No one of us obviously have expected that such a tragedy happened with the aggression of the Russian when they started the war against Ukraine. And that changes everything from one day to another. And if you see this massive shift from negative interest rates to flat and then into positive territories, I would say most of us get caught on the wrong foot. And then it causes a high degree double-digit figures of inflation, this Damocles sword of a recession coming in next year. How long will it stay? And so for issuers who remain frequent issuers in a high let's say degree and volume, they have definitely to play the opportunities of intraday windows. I say in particular intraday windows, because even in a day we saw swings just recently 10 days ago, I think was it 10 days ago roughly, when we had been all in Washington, or most of us in Washington, when the Bund future were first plus 160, then minus 50 in a day. So these swings are really massive, yeah? And to find then the right window of opportunity which not disturb your books and you still have a good solid book to place a volume is different. It is for sovereigns who have, for example, a calendar where they really have to raise volume on a specific announced day, which is, I don't want to go into details now, but the sovereigns among us here know what I'm talking about then, yes? And then you have obviously certain maturities, and given the current shift of the curve, as longer you go out the curve, as more difficult it gets, except you are very generous in what you are happy to pay and accept as a coupon then, yeah? So to my personal opinion, you would need to have partners who know and who are very, let's say, hidden champion in their own domestic markets, who are not serving just fast money accounts, who are serving long-term or medium to long-term investors, more buy and hold investors, not to cause a synthetic on top volatility in markets then, yeah. But I forecast a very rough sea, may I say so, for 2023 at least.
Is it certain maturities that you're seeing that are more difficult? You said further out the curve is it perhaps a bit more easier than the short end?
Yeah, take the euro inflation rate double digits, then we have 1%, probably soon 1.75 or even 2. But still there's a big gap in between then, yes? So you don't need to have a lot of fantasy where the rates go, yeah? And so the hardest impact is in the longer maturities. If you are a permanent investor and you don't care and you can have a view of 10 years plus, you probably don't care so much. But for those who also might gonna need the liquidity in between, I mean, I can just refer now to what Austria have issued was a 100-year bond at par, and now it's trading, what, 35 or something like that? Big figure. I mean, it's just an example. And you have, as an investor, you have to go into the mark-to-market P&L. And So the long end will become definitely more and more difficult. But I will also say something hopefully positive. There are certain other asset classes. And if you take the real estate market, I mean, this is the underlying for most of the covered bond issuing volumes we have seen and see. What do you expect in the current costs of construction then? Yes. And you know, this market is not turning around that quick and given up. And I would forecast that we will see a huge decrease of volume next year and probably even the year after. So which means the former investors into covered bonds who definitely pay up over SSAs and sovereigns, they have to sniff around for alternatives. And I can't imagine in such kind of markets that they go for less quality. So I think from that side, you can see at least a kind of support in the world of SSAs and sovereigns.
Okay, thanks. I'll just turn to Sven. There's been quite a few difficult deals in the last few weeks, but because we've got you, and because you recently did a transaction, a 3-year transaction, what was your experience like? I mean, that deal was only marginally covered, but obviously your deal was not in isolation of other deals. But what was the feedback you got? Why investors were a bit hesitant to buy that transaction recently?
Yeah, interesting question. As you said, we experienced, a weaker demand, which we got used to, of course. But actually, it was a mix of things which contributed to that weaker demand. First, I have to state, we are approaching the end of the year. So you could say by nature, investors tend to close their books. Second, we saw, of course, headline risk, ECB, TLTRO, purchasing programs, etc. That, of course, caused something in that transaction. Third, we saw uncommon volatility coming from the UK, especially during that time. Some people here at the floor said it was crazy, but it worked out in the end. So volatility from the UK caused, of course, uncertainties in the euros as well. Overall, uncertainty over ECB's next steps and rate hikes caused as well uncommon volatility. Fourth, I would like to state that we, at that time, we were really expensive versus swaps. So a mid-swap minus 47 for KfW really marked the tightest ever non-EGB SSA Euro benchmark versus mid-swaps. So for investors, it was really expensive, that transaction. So we are really happy and we're happy that it worked out. We closed the books at 3 billion euros. So overall, happy. We were happy in crazy times. We are now at 87.4 billion euros in funding for the current year. So quite close to the envisaged volume of 90 billion euros. So at the end, it worked out quite positive.
Yeah, thanks, Ben. I mean, you mentioned the tight levels that KfW now price in trades at. Do you see yourselves more as shifting towards a sort of quasi-sovereign issuer now, moving away from the sort of other agencies?
Pardon, Born, I got it.
Sorry.
I couldn't understand you.
Oh, sorry. Can you hear me now?
Yes.
Yeah, I was just saying you mentioned the tight levels that KfW prices in trades at. Do you see KfW sort of as it's sort of drifting away towards more like a sovereign issuer in terms of pricing?
That's interesting to say. So No, of course, we are not a sovereign. I mean, when it comes to the volumes, of course, we are quite close, but we are an SSA. We will be an SSA in the future. Levels depend on the markets. I can't foresee the future. So let's say it like this for the moment.
Okay. Yeah, maybe Patrick, you can give a perspective on how you're viewing European SSA names right now. You know, is it a mixture of things that are causing you to be a bit more reluctant to buy these names? As you mentioned, UK volatility, uncertainty from the ECB. What are your main sort of concerns?
Well, just to add some comments, I would like to highlight that the swap spread increase was perhaps a driver of the performance of the portfolio managers, investors. So SSA are under the pressure of the swap spread, and to tighten the swap spread, perhaps it's the first step to recover the demand. And as it was mentioned, the duration is clearly the question today for investors. It's difficult to invest today when the market is so volatile, but more than volatile, it's still a sell-off. So again, what could be important for SSA is to have a better view on the long-term picture of the rate level. What could be well, in a kind of transition period from negative rate to normal rates, and of course in this period of time, investors are managing mostly their active risky bets, and not this one, credit, bank exposure, to be clear with you. So there is perhaps market distortion, perhaps the market is not focused on that issuers. Today, well, there is a kind of barbell strategy, the Bund, the WATI, the BTP, and the credit market, to be clear. And the swap tightening should be, for me, for the next year, the main trade where, for example, we overweight swap spread exposure directly and not so sovereign.
I guess same question for you, Casper. I mean, how are you sort of viewing SSAs right now? Is it a mixture of factors that are causing you to be a bit more reluctant?
Yeah, I hear you can. I hope you can now. I'll speak it slow. In general, what we have learned from UK is that there are no long investors if there's no lender of last resort. So there needs to be a structure. The market participants need to know that as well. What we would say is that there is still a demand for collateral, but this time that is in the end. And also there could be a market for currently established. The US money market is still the market globally. There is no European equivalent. So all of that take competition away from for governments in the longer end, and would establish European money market, and that would have a risk and so with regard to swap spread, because they are based at the end, or there the problem starts first. So that is really the takeaway with inflation that high, that the front end is underdeveloped, and that in general times of stress that has to be developed. And we as had in this as well, where the Treasury is announcing or asking if they should back loans to liquidity to the market. The Treasury there is in some form of operation risk, and that is something we would like to approach their thinking on how to establish the front and how to support the long end. We haven't seen that yet, so a bit of flexibility would be great.
Okay, thanks, Casper. We haven't talked about sustainability, but maybe just a question around this. I mean, Frank, is it easier for issuers to sell ESG label bonds in these current market conditions than sort of conventional bonds?
Well, the easy answer is yes, but the but is obviously you have to be also seen and accepted with what you're going to issue and what your underlying is. The investors these days are looking much more deeply into it. And if the criteria are also compared to what you're going to live and also over time. So you have to provide the correct data and they have to reflect the facts of the underlying, yes. But as I said, the answer is clearly yes, because there's still so much liquidity around and not enough product in general terms speaking then, yes. But obviously you have to have a look of the credit quality and underlying, and therefore we also depend very much on Moody's and others of their competitors, which we work very close together with. Even they are not sitting around here, but the corporate world, it's even more complex and difficult to find acceptance there. Yeah? But also you need to have a good cooperation with the stock exchanges, marketplaces. As I said before, one of the best is we are guests here. We heard it from Julie. Carlo, meanwhile, has arrived and know what I'm talking with. And the cooperation here among the three major time zones is very important also on a sovereign and SSA level. And if I go back in history, and I'm now attending the annual COP meetings since more than 12, 15 years. In the beginning, there was very silent, no capital market people. And if sovereign people were around, definitely from different ministries, not from the finance ministry, or unlike agencies. But this has changed massively, and if I see it correctly, what this year will happen in Sharm el-Sheikh, in particular, also the SSAs and sovereign debt issuers or the ministries will be presented there, and they're all going to talk. So I think this will just grow, and I will also outline the transition of what will happen, and so-called transition bonds under whatever framework they will come is probably one of the most growing markets we can foresee for the next coming years, because they reflect exactly what we need most to make sure. And again, Moody's and others are very helpful there, is to get the SMEs also in line with it. And why do I say that and outline the SMEs? Because the promotional banks among us here, EIB, KfW, and so on and so forth, they do a great job here together with the private sector banks and make sure that there are a lot of issuance will come. So this is what I overall foresee, a huge growth of further issuing, whether it comes from sovereign SSAs or even in the corporate markets.
Yeah, thank you, Frank. I want to just talk a little bit about the outlook now for next year. I'll start with you, Sandeep. I mean, what from EIB's perspective, what are your big concerns for next year? And can you give us an insight into your funding program for next year in terms of will it be bigger than this year's, and how will you sort of navigate, yes, all this volatility next year?
Thanks, Varun. Clearly, we have no crystal ball, so it's kind of hard to talk about macro themes. But I think 2 or 3 things are clear just from the discussions we've had this morning. One of which is that given the economic outlook, given inflation, given fiscal stimulus being planned by various people, given the energy crisis, issuance is going to grow. And so we expect gross issuance to be substantially higher. And given the absence of QE absorbing some of that in the secondary market, the absorption capacity of the private sector needs to step up to absorb that gross issuance. I think the ameliorating factor to that is that the next year has a reasonably high degree of redemptions as well. To some extent, that gross issuance, or the net issuance, I should say, should not be particularly different from that of this year. Christian sort of referred to, and we've sort of talked a lot about the sovereign versus SSA topic. And I think at the root cause of that seems to be some market dislocations that we've seen all year, which can easily be pinned onto swap spreads and what they've done in breaking the historical relationships between SSAs, hybrid sovereigns, whatever you want to call it, and EGBs. Those historical relationships, I think, will come back into line, as we've already seen a number of moves on the collateral side, expected moves on TLTRO side are going to get more collateral into the market, and swap spreads should start and already have started coming back towards historical norms. I should say they're still quite far away from historical norms. So we expect some of that to happen. I think it's also fair to say that although we've seen credit spreads widen out, if you look at any credit indices, they have widened out substantially. We haven't seen a major credit event. And that is always something, it's a known unknown. Having said that, the issuers represented around the table represent either risk-free assets or safe assets or sovereign assets. So we generally tend to benefit from some flight to quality. And so we should be able to tide all of that. And I think that's as far. The other thing I suppose is point Frank was making, which is that during the period of QE, there's been a whole bunch of credit convergence. In other words, credit spreads have squeezed in quite substantially. And Frank cited covered bonds as an example where we expect spreads to get wider. And so if credit divergence starts taking place back to historical norms, again, I suppose assets of this nature would benefit from that. As far as the IB is concerned, our medium-term outlook on our funding program is reasonably stable, so somewhere between 45 and 55 billion, so relatively small around this table, and KFW. And we don't expect that to change. We'll continue being a multi-currency issuer, so roughly about 50% of our program gets done in euros, and about a third gets done in dollars, and the rest in a number of other currencies, and that's unlikely to change. We are a net negative supplier of bonds after redemptions. Again, we don't see that changing for the foreseeable future.
Okay, thanks, Sandeep. I guess same question for you, Sven, at KFW. What's your sort of insights for next year's funding program and your sort of main concerns?
Yes, as Sandeep said, we don't have the crystal ball too here at KFW. So what we have achieved now is the 90 billion target for the current year. That's really a tough goal. It's a large number. So nearly every day we got questions, is there any pre-funding for KFW? And we have to say that is nothing we are currently working on in the current markets. As I said, we have to achieve the envisaged volume of 90 billion first. When it comes to the next year, it will depend on the business planning of KFW Group, and that business planning hasn't finalized yet, as in the previous years. So, like every year, we will announce the funding volume for the next year only in December. That's what I can officially state here. What I can say to the US dollar is that there are in general no maturity targets for the US dollar. However, it will be our goal, as in the previous years, to issue every quarter US dollar transaction, which should have a larger size. The outlook in the US dollar especially is tricky, with US treasuries now touching the highest yields within the last 15 years, as we saw it in the last week. But we are convinced of the attractiveness of the US dollar market also for next year, especially then there are or would be signs that yields could fall in connection with markets starting to price in pivot of the rate hike path from the Fed. That might be a moment when we tap US dollar market again next year. However, currently it's hard to say any positive things about the US dollar issuances at KFW. The only thing I can say is that we are really happy with the front loading we did this year. that was really positive. Currently, we see quite cautious central banks, driven mainly by currency interventions. In addition, quantitative tightening of the Fed with regard to new debt, that is something we see, and that causes pressure on the spreads, which are tightening in especially to US dollar swap spreads in a way that deteriorates the valuation of KfW's bonds against swaps. From the US dollar to the Australian dollar, the Australian dollar was always a currency channel and an issuance and channel for KfW. The Aussie market is very reactive to global volatility, which therefore made funding in this market challenging this year. Once we see a normalization in volatility in the Australian dollar market, the market should provide decent issuance windows for us as well next year. The RBA, in my opinion, is the first central bank in the developed world which pivoted and which will monitor the impact of its policy before taking further steps. So in a way, it might be a front runner in the market. Let's see. We expect the Australian dollar market to remain one of our 4 top funding currencies at KfW for next year. And hence it will rank us among the top issuers in the kangaroo market, hopefully.
And can I just jump in quickly? I wanted to reference something that Patrick said earlier. I think it's very easy for us sitting here in Europe we know what NextGen EU is, we know what EIB is, we know what KfW is, but Patrick mentioned other investors around the world who maybe aren't as familiar. And Sandeep, I just wondered, you talked in very positive terms about the impact of NGEU at the start. But do you sometimes, obviously EIB has been in so many markets with so many investor bases for so long, in many currencies, and they know who you are. But does the NGU sometimes get them to say, well, now NGU is here, who are you and what are you doing and how do you actually work together? And what is this Team Europe thing? I mean, does that come up? And if so, how do you deal with it? And I wonder whether also, Christian, whether that sometimes comes up in the investor meetings that you have as well. Where do you fit in this ecosystem if you're talking to a big Japanese investor or a big US investor or something like that? Maybe Sandeep first.
I think it's more eloquent today.
No, thanks for the question, Ed. It's a very important part of our daily work to explain basically who we are and how we fit into the bigger picture. Certainly, there are a lot of investors out there that are not yet that familiar. It is also true that investors outside Europe tend to have even less familiarity with the structures, and therefore there is a higher need for us to basically go to these investors and to explain who we are. We see now an increasing interest in Europe, also because the negative rate environment is gone. So yields are at interesting levels again, and we see a lot more interest and request for bilateral exchanges just to see how we fit into the bigger picture, certainly.
Thank you. Sandy, quickly talk on that as
Sure.
well.
So look, the SSA market's always been an alphabet soup of acronyms, right? So it's not that investors haven't sort of learned over the years how to navigate this market. You're right, as I was mentioning earlier, there's a bunch of e-names now, and people need to distinguish between some of these, and but it's not particularly difficult. I think the mandates of the 3 institutions that we talk about as e-names are so very different, and EIB's historical presence sort of makes sure that the familiarity with the EIB is certainly there. So it's not very difficult to explain what ESM's up to or what the EU is up to. And as you're talking about, EU's got its own status of the collective debt issuance entity for the EU, doing a whole bunch of things. Of course, if you zoom out, then we're all working towards the development, growth, and prosperity of Europe. And so, but that's no confusing matter. It's sort of Is there an ideal world where all you debt issuance institutions ought to be harmonized in, one collective body? Sure, but everyone understands we don't live in an ideal world. And at the moment, there's enough initiatives and different initiatives going on under various different mandates of these institutions. So it's not it's not a hard story to explain to investors, but you're right that it does come up from time to time for those particularly who are starting to look at European markets in particular and haven't done so for a while.
Yeah, thanks. That's something. Frank, I think you had something on this.
No, I think it was more or less always there, particularly since the financial crisis 15 years ago, or roughly 15 years ago, 14 years to be precise. But I think what is needed, and I agree with my colleagues on the right, and also what Sandeep outlined, even the investors far away from our time zone, in particular in Asia Pacific, and they know the individual credits for quite a long, but constantly, like in an investor relationship, it would be good in a discussion. And I can speak from experience, because we have found it like 2 years after the financial crisis started. In 2010, we started with an annual trip called Day on Europe. Why did we call it Day on Europe? Because it was exactly the rising east. The EIB, very well known for ages. Then also, in addition, the EMU, what was it called? The first issuer name, not ESM, it was Exactly, and the ESSF, and then ESM joined as well, Council of Europe as a smaller one, to explain a little bit for those who don't live among us here in the European system, and this often overseen political patchwork of complexity, to explain and to go into a discussion on stage. And we always went to Korea, to Greater China, sometimes Hong Kong, sometimes Singapore. With another bank, they did Japan. Obviously, there we didn't contribute it, but so on and so forth. So we worked already out a kind of investor relation, and that was very much welcome. And I think we need that to do that again now after COVID, more or less. I couldn't say fully covered, but allow us to travel again. And according to my information I got this morning, even China is starting now to open up mainland China and allows us to travel again. If this is politically okay, yeah, and this is a big question mark, I think we should go there right away and immediately. That would be of help. And we could not forget, it's not just one of the largest or the largest creditor to the US, also to us here in Europe then, yes. And so therefore we should do our investor relationship job at best together. And I think there's a lot to gain and a lot to explain as well. Yeah.
So I guess given the restrictions, NGU will not have been to China yet, Christian. Is that something on the agenda at the point where it opens up? Because obviously we are talking about a very large investor base there.
So first of all, we don't market it as NGU. We are the EU as the issuer. So the EU as the issuer has been around for quite a while. And there have been investments from all over the world. But since the initiation of Next Generation EU, we have not done a physical outreach mission to China. At least there were contacts, but it's, COVID times, and as I said, China is more restrictive, so there has been certain limitations. I think what is clear is that if we want to, we need to be mindful about our investor base, but if we want to market our issuance also outside the euro area, we have to globally market it to all the relevant investor groups, and certainly from China we have a lot of investments also in our bonds, so that's absolutely clear.
Yeah, one of the questions I wanted to ask was whether we've talked about the increased focus on Team Europe and also on the higher rates. Are you seeing sort of the return of old investors into your order books from when rates were positive before? Sandeep, can I ask you that? Are you seeing sort of the return of old investors now rates are higher?
So I suppose the short answer is yes, of course. And as Patrick mentioned, as the yield curve has transitioned from being all negative to all positive. But it's a short period of time, and it's hard to sort of dig out any trends that are meaningful in any particular way. So it's true that the number of central banks who could not buy negative rates because their mandates didn't allow them to, they've started to come back and make an appearance. It's also true a number of sort of non-European investors shied away from regardless of the cross-currency swap, shied away from negative rates. They've started to come back. But have we seen, well, actually higher rates have helped on the asset manager side. A whole bunch of pension funds, insurance companies who had certain bogeys of seeing, you know, whatever number you want to pick, 2.5%, 3% yields, and so on and so forth. Some of these investors have started to come back, but it's only the beginning. And so the composition of our investor books from last year to this year hasn't changed in any material way to point to any particular trend as standing out. But all of these things are filtering through as time goes on.
Maybe Sven, is that a similar sort of dynamic you're seeing? But is it too early to sort of, I guess, draw any sort of meaningful conclusions from that?
Yeah, and nothing different here at KfW. So as Sandeep said, it's time is too short to say something about trends. We haven't seen big changes in the books.
Yeah, and maybe Christian as well. Maybe to tie in that bit about your sort of outlook for next year as well, but starting with the composition of your order books at the moment.
I've already pointed to the fact that we see an increased interest outside the euro area, and that has to do with the changing rates, certainly. And that's a positive development. And we do, or we invest a lot of time and effort in trying to tour the world and explain to the potential investors who we are, and try to give them a better picture of what investment opportunities are there. Looking to 2023, as I understood, this was also part of your question. For us, Sandeep has already alluded to, it will be a very congested, very full calendar next year. Also for us, funding volumes will certainly not go down. So we come out of a funding year where we have raised now about 100 billion. We go into a year where 100 to 150 billion was always our range of issuance for the rollover out of NGU. If we stay at the lower level like this year, it will probably not be possible to roll it out in full. So it's mathematically to be expected that the funding volumes will grow, and that while there will be also other new issuance and new net issuance coming to the market, and that is something that we will need to manage. There are some silver linings. We heard that. I think the current situation we see in the market, particularly with regard to swap spreads, will hopefully normalize a little bit, which will give us a better environment. But it will be challenging. I think the best we can do to navigate that and to get through that is to continue what we have now done throughout the whole issuance over the last 1 to 2 years, is to be very predictable in our issuance, to be diversified, and to adapt to market conditions in the best way possible. So I think the main pillar of our work is trying to understand investor needs and preferences, and try to gear our issuance towards that. And we will certainly try to continue to do that in the best way possible. We are a little bit limited in terms of amounts, because we can only issue what is actually needed in terms of disbursements. So we cannot issue whenever we want and whatever amounts we want. So that limits us a little bit in the way how we organize it across the funding terms, which are in our case 6 months. But within these terms, we can structure it in line with market conditions. So that's all I can say. And we will also come out with our funding planning for the first half of next year in the next month. Usually around December, we publish our funding targets for the next half year.
Christian, might changing market conditions affect your mix of syndications and auctions?
So generally, we are still in the build-up phase of our auction program. So we have always communicated that it is our clear objective to increase the share of auctions compared to syndications that we had so far. So that's a more structural development. And then we need to see how that is implementable in the current market environment. We have certainly seen that over the last half year in particular, execution risk has significantly increased. And we need to see how much execution risk we can take in the first half of next year. And that will determine how we set the cursor then between auctions and syndications. But as said, over the medium term, it is absolutely, so the direction of travel is very clear that we want to increase the share of auctions and bring it more in line with our sovereign issuer colleagues, how they structure their issuance programs.
We've got a few minutes. If any other questions from anyone else in the room, for any of the panelists or oh, Casper, have you got a question? I'm having some trouble with your. We can't hear you, Casper, I'm afraid.
Can you hear me now?
Oh, yeah.
Luckily, we have a crystal ball, and we know that inflation will remain high, and the EU will most likely go to 3%, if not more. That means the high cash rates, but luckily there is huge cash right now. So bringing on these higher rates to investors, foreign and domestic, in the front end will be a very positive signal for the euro, if that is correctly.
Okay, yeah, thanks, Casper. Any other questions from anyone else in the room?
Well, if we have a look beyond the market turmoil, etc., as you know, the question is about the thematic of the bond insurance. What is really an issue that there are a lack of demand for sovereign and SSA, and that's why you have more syndications than because yes, there is no natural buyer of duration every time due to the market. But do you expect for the year to come to have perhaps more ESG bonds, green bonds, thematic bonds? Because this is something still popular despite the market turmoil. And I think the way to match the needs of investors, especially for SSA, for sovereign also, compared to the other parts of the market, is to focus more on that type of bonds, which show even demand for private investors in Asia. Of course, it's a way also to differentiate from the US market. You ask, in the US, it's less popular. There are less issuance. And of course, if you have a demand coming from Switzerland, Asia, Eurozone, I think it should be a good way to promote EU issuer, to promote all the European issuer due to our thematic view, and especially we have many plans in the Eurozone, a lot of projects, and that's something we should promote, especially in Asia, I think. I don't know what you mean.
Okay. No, I very much agree, and I should have probably talked a little bit more in this group about our green bond program. It's a very important pillar of our funding approach. And as was mentioned before, the Commission has committed itself to issue up to 30% of its issuance under Next Generation EU in the form of green bonds. And we manage that not as a separate issuance program, but as an integral part of our overall funding strategy. So we are basically not limiting that to certain maturities, but we want to broaden actually also the spectrum of maturities out to speak to a wider group of investors. And we see that there's a lot of interest and demand for particularly green bonds out there. So this is certainly something that we will use, and we will integrate into our normal funding planning, a regular diversified issuance of green bonds as part of our overall issuance program, and that is something we experience as helpful in fostering and stimulating demand from the investors.
Okay, I think we're just about run out of time for the first session. So thank you to everybody for the participation. Some very interesting stuff there. We've done the sovereign style, and we've done the agency, and we've done the supranational. We'll go full on sovereign after the break, with 4 big European sovereigns speaking on the next panel. I think we're going to talk a lot about market conditions. We're going to talk a lot about risk, demand, and managing through the volatility that we see now. But thank you to our first panel, both in the room and virtually, for your discussions there. If you're watching us virtually, please join us again in about 15 minutes time for the second session. Thank you. Hello, everyone. Welcome back. Thanks for staying with us if you're online. Thanks for staying with us in the room. We're going to focus now on sovereign borrowers in the Eurozone. And we are joined on this panel by Cyril Rousseau, who's Chief Executive of Agence France Trésor. Cyril, nice to see you over there. We have Tamer Dieber, who is the member of the management board of Deutsche Finanzagentur. Tamer, hello. We have Karen van der Wiel, who is head of policy and risk management, Dutch Straight Treasury Agency. Hi, Karen. Davide Iacovoni, who is the Director General of Public Debt, Ministry of Economy and Finance, Italy. Davide, welcome. And also Patrick Barb, who we've heard from earlier, who is head of European investment grade fixed income at Neuberger Berman. We're going to get into some nitty gritty of the markets over the next hour or so. But I think to start off, it would be good for each of our issuers to give us some insight into their recent activities in the market, and how they see market conditions right now, some of the recent deals, and just to get a sense of what the market's like. And Cyril, as you're joining us virtually, but to make you feel absolutely part of the group here, maybe we could come to you first and you could give us a quick insight into AFT.
Sure, and very happy to be with you, and unfortunately not being able to be present in Luxembourg, given the fact that we have an operation going on for one of our agencies. What is striking this year, obviously, is a rapid increase in yield, and how it impacts the market. What is the impact in terms of how we conduct our business this year? When I look at metrics like how we advance and implement our funding program, I see that it's very consistent with what it was last year or the previous year. So what is changing this year is the yield level for sure. Also the volatility of the market. Clearly, we have this volatility translates into more volatility at the time of auction. Also more volatility on syndication, which means that, for instance, for syndication, you have to take into account the fact, A, that there will be less windows, so you have more often the need to coordinate with your peers in order to make sure that the operation goes smoothly. And B, the fact that this volatility also translates into higher risk for investors, hence higher new issue premium. That being said, given the fact that for the case of AFT, we only rely on syndication for a few operations during the year. We did 3 syndications this year. So overall, it's something like 5 to 7% of the funding program. The overall impact of this situation for us is, I would say, limited. And what we have seen is that actually market has been quite resilient to this very, very rapid change in terms of rate anticipation and inflation expectations. So that would be my quick introduction to the session.
Thank you, Cyril. That's a very helpful starting point. I'll go around the table and do the same thing. Maybe Davide, you could tell us a little about Italy's experiences at the moment.
Can you hear me? Yeah, I hope so. Thank you very much, first of all, Clive, for invited us to this conference. But I more or less I can follow what Cyril would say for France. I mean, despite this year has been a pretty challenging year under many points of view, and not only with reference to the geopolitical situation, the energy crisis, inflation, and so on. But of course, in Italy, we also had an unexpected, say, end of legislature. We went to elections, a new government, and so on. But I have to say that, as Cyril was saying, we are not so different in terms of state of progress of our funding if compared to the previous years. Maybe with the exception of 2021 last year, because there was a lot of uncertainty regarding our true funding needs. And so we end up issuing quite massively over the first 6 months, and then we realize that we overfunded, let's say, and so we slow down our activity over the rest of the year. But so if we compare, so the first 9 months or 10 months of this year compared last year, the percentage of funding progress is this year is slightly lower. But then if you go back to the years before COVID, we are almost perfectly aligned. So say more or less we have closed 83-84% of our funding. In terms of issuance method, the way we have approached the markets, where we, as you know, we have a very well established auction calendar and program, and so most of the funding goes through that. Of course, we have seen structurally more volatility around the auctions than in ordinary times, but I have to say that in the end, almost all of them went fine, also with some decent performance of the bonds that were auctioned after the auction themselves. Then we carried out, if I'm not mistaken, 5 syndications. A couple of them were carried out in the first 2 months, so in a context that was much less volatile than after the February ECB meeting, and then things changed quite significantly. But despite that, we have been able to carry out the following syndication quite well, with good results all of them. But I can't deny it that in some cases we were forced to revise the initial timing that we had in mind, because of course in this volatile context, the windows available are less, so you have to be ready and recognize when it's the right time, and sometimes this is not easy. The final transaction, however, that we carried out in September was a green bond, and I have to say it was a new green bond. And I have to say in this case, however, we have seen that there is some stickiness of, especially coming from ESG investors, that despite the volatile market conditions, allow the transaction to be carried out quite successfully. So for this year, in the end, we are quite sure that the rest of the funding will be really manageable, even if the new government will decide for some marginal intervention to cope with the energy crisis for the rest of the month, because the current interventions goes up until mid-November, so they have to add some new money to be spent from up to the end of the year, but it's a small amount, so this will not change in any case our funding for this year. Different story, but I think this we will have time to talk about. It will be next year, where there are several challenges but also opportunities, but I'll be more detailed in the following questions.
We'll definitely come back to the challenges of next year, Davide, but thank you for that. Karen, where is the Dutch State Treasury Agency at in terms of its issuance of the year, and how has your approach to markets changed during a year that has changed somewhat?
Thank you for also inviting us, Clive. It's nice to be here in Luxembourg. Actually, so far, market circumstances have obviously been very challenging. Interest rates have gone up, as we all know, but I must say that the funding has gone rather smooth up to now. We're almost done for the year in terms of capital funding, so we have one more auction left in November. So indeed, it's sort of I guess we're happy that we front loaded as all of us, I guess, usually do. But we haven't had huge difficulties in auctions so far. We had 3 Dutch direct auctions. We don't do syndications. A usual 10-year. We did a big reopening of a green bond in June with a new framework that almost aligned to the taxonomy, and we did a 30-year, extended our curve in the end of September, and yeah, that's all of them went rather well. Also, the tap auctions, I guess, where the challenges was in pricing the tap auctions. Sometimes it was difficult to spot the right mid price in these volatile conditions. I think in the end it went well, but that was challenging. Also, we've seen we serve as a lender of last resort in the repo market to our primary dealers, and we've seen much higher demand there, and sometimes in pricing also the repo transactions that has been challenging because the repo market doesn't always function very well, but there also we could solve it with a bit of creativity. And I guess that our biggest challenge is what Davide also referred to is the funding uncertainty, this uncertainty about our funding need. In COVID times, the funding need was overestimated time and time again. So the spending that the government expected to do on the programs, the support programs, was always overestimated. And even this year, even though they're not, I mean, even though the COVID support programs have ceased to exist, we still see this huge uncertainty. Now, I guess the inflation is a big part of that. We don't issue inflation-linked bonds, and government does receive more tax income because of the high inflation. So that's also the reason why in the fourth quarter we only have these 2 tap auctions, because somehow also the Dutch economy has outperformed forecasts. So I guess that's good news for the Netherlands, but for us it's challenging to know how to what to fund and how to do it. And I'm pretty sure next year will be even more uncertain about what we need to fund.
Thank you, Karen. We'll probably get onto the subject of creativity a little bit later as well. Tammo, we've always taken a fairly stern approach in the auction market. The Finansagentur will issue when it can, but if the bid is not there, it may not actually go through. So how are you finding these markets right now?
Thanks for having me, Clive. And I'd like to sort of add to what my colleagues said from the Netherlands, Italy, and France. The
Markets are very volatile, that has been said. This is observable. And German government bonds are very expensive. I mean, you can, on a relative value basis, so compared to swaps, even compared to our colleagues from KfW, that they share the same creditworthiness as the Federal Republic of Germany, but German government bonds trade on record levels compared to KfW bond from a spread perspective. They are very expensive. And not only that, but you can also see that there's a lot of demand in the repo market for German government bonds. You see this when you sort of look for the forward repo rate over year end. You've seen this 4 weeks ago already, and even 2 months ago already, that there is a lot of demand. Our explanation here is that the need for collateral, I mean, to place it at the CCPs, at counterparts, is extremely high. If you take, say, if you take the numbers from Eurex or from the London Stock Exchange, the amount of initial margins that market participants have to pay, I mean, this doubled and tripled compared to last year figures. So there is a lot of demand, and this results in fairly high prices. And on the other hand, our auctions in the primary market over the last, say, 2, 3, 4 auctions that we that we observed, the result is the demand is reduced, really. And our explanation here is that it is really the volatility that makes it difficult for market participants to be actually up and there at the moment in time for the auction. The members of the Bund auction groups, they take risk when they bid in an auction of the Federal Republic of Germany, and therefore these things are limited and more challenging in these volatile circumstances. And to the contrary, is the secondary market. I mean, also it is an observation of ours that bid-offer spreads are higher than a year ago. So also a reflection of the higher volatility. So market makers have to sort of take an adequate approach to their trading activities, and therefore they widened bid-offer spreads also in German government bonds on screen. A second aspect is that the traded volume per trade is reduced. Even with us, we observe this. So this is a natural reaction of market participants to this situation. So in the secondary market, and we are an active player in the secondary market, as you know, actually we have very good demand for German government bonds, but with those two aspects in mind. So the ticket sizes are smaller. So we run much more tickets per day than in the past in order to sort of distribute the same amount of funding. And this sort of is the conclusion we need to draw from these very volatile markets.
Just on the question of the bid-offer spreads, are they higher but returning to what we might call a more normal pre-QE level, or are they higher than they would normally be, even in those terms?
I think if there is more clarity going forward, what is sort of the central bank's policy, where is inflation targeting or stabilizing? When will it come back to sort of normal levels? Is it in a year's time? Is it in 2 years' time? If there is hopefully more certainty on a geopolitical level going forward, then clearly volatility will go back to normal amounts. And then also it is a natural reaction of market making in liquid segments like government bonds. Then a normal reaction is that market makers must reduce their bid-offer spread again in order to be competitive. So for the time being, I'm not positive on this. And so the bid-offer spread is an indication for that. But going forward, we will come back to those levels we have seen a year ago, but it will take time and it needs to be more clear to all market participants what rules the world.
Thanks, Tamo. And we'll certainly come back to the role of market makers and syndicate groups and so forth in these markets in due course. And Patrick, I'll come to you in a second just on the investor viewpoint. But what Tamo was talking about in terms of the need for collateral, is that something, Cyril, that you're seeing at AFT? Is that impacting you in any way?
Not in the same way, no. Actually, we have in place a facility to be able to lend securities in case of a tension on a given bond. The standing facility has been there for years and years. And the last time we used it was more than 1 year ago. So which means that we are not facing the same situation in terms of demand, specific demand for collateral. So I guess that our most special bond right now is just the cheapest to deliver of the 10-year contract. We don't have a set of very, very special bonds. Maybe one explanation, I mean, at least two explanations for that. One is the overall size of our bonds. I mean, we have per GDP debt, which is much higher than Germany, and our lines. I mean, we have lines which are above 50 billion euro of outstanding. The other one maybe is also possibly the way our central bank is lending the securities to primary dealers, which probably makes it easier for primary dealers to access those bonds. Hence, they don't need to ask us for the issuance of such collateral. That being said, we nevertheless, as market participants, are facing the overall issue of the shortage of collateral. And to give you an example, if we were to do a reverse repo in order to invest our cash, we know that that would be difficult, and this is one of the reasons which has led the ECB to take a decision on this in September.
Thank you, Cyril. Just going back to secondary markets and bid-offer spreads, Davide, are you seeing wider bid-offer spreads in your government securities? Is that something that concerns you? Are you also maybe seeing the same thing which Tamo described in terms of ticket sizes?
Okay. Yes, this is a very serious issue that we are facing too, and I have to say it's something we look at very carefully because the liquidity on the secondary market for us has always been a crucial driver for a sound funding activity on the primary market. What we have been experiencing over the last months, for sure, is a general reductions on volume traded overall. I was looking at some data in these days with my colleagues, and we've seen basically, for example, that the volumes traded on the dealer platforms in the third quarter were more or less in line with volume of 2020, where we were having in the months before, of course, the second quarter of 2020 was very, very bad with massive reductions of volumes for the reasons that we know. But then we've started seeing some recoveries in volume in the third quarter, but we're still very lower with respect to ordinary times. And now we are back to the same level of the third quarter of 2020. It's not very dramatic situation in the sense we experienced periods of lower volumes, but definitely something that we are looking at. The other trend is, of course, in terms of bid-ask spread. We have seen a general widening of bid-ask spreads over all segments. Definitely, we are around this. In this case, we are around the levels that we had during the second and third quarter of 2020. However, the situation is not homogeneous across the curve. For example, the points of the curve that are covered by future contracts tend to behave better in terms of bid-ask spread, basically because dealers have these hedging tools that they can use, and so these tend to help in this case. But if I compare with other part of the curve, for example, the long-dated bonds, of course, are those that are experiencing the highest increase in volatility. And so as a consequence, bid-ask have widened quite significantly. We are, of course, trying to put in place several actions in trying to cope with the situation. Of course, we are using also the repo market. We are active on the repo segment since May of last year. And in some cases, our activity on providing the bonds has helped the functioning of the market. But as Cyril was saying, it's not very large so far, because we haven't experienced massive specialness in general of our bonds, except some few cases. The situation has not been so bad in terms of specialness. So operating through repo is just one line of action. On the other side, we are trying to also being active, has always been in what we call the liability management activities, which means doing buybacks and exchanges, which have always proved to be quite effective. We carried out these transactions in several ways, whether through the Bank of Italy auction system or directly through a devoted section of the MTS, or sometimes also bilaterally. This is definitely an activity that we're carrying out this year. We'll keep on doing over the years, of the rest of this year and in the future. Another line of action that we are using is in terms of, say, adjusting the way we evaluate primary dealers in order to be more effective in providing liquidity in the secondary market and try to tighten as much as possible bid-ask spreads. In recent times, we have an increase in number of primary dealers. If you want, we can come back on this point later. But of course, these should help. But at the same time, we are thinking about the opportunity to adjust some of the valuation criteria for next year in order to be more effective in terms of providing incentives to dealers to improve the situation on the secondary market. Finally, I want just to mimic what Tamo was saying, that of course it's extremely important that that some stability is found at a given point when will be more clarity regarding the ECB policy and the geopolitical situation that is causing inflation to go up. So the general underlying thought is that if these issues are not really solved, then we'll probably need to live with this volatility and lower liquidity for a while. However, from our side, we will do whatever we can to cope with the situation that I have to say so far has not really endangered our capacity to place bonds in the primary market. But definitely this is something that we need to keep on working on the following months.
Thank you, Davide. Before I come to you, Patrick, Tamo, can you tell us a little bit about the rationale and the process and the way that will work your plans that you announced to tap, I think it's 18 outstanding issues in order to sort of like promote more liquidity via the repo market and the thinking behind that?
Yeah, we benefit from the fact that our budget law allows us to hold our own bonds on the asset side, so to say. So we can issue more than we sell. We can issue more than we need and buy it back, for instance. And those own holdings give us the opportunity to act not only in the secondary market by selling it to add to our funding needs, but also to use them as collateral in the repo market for either cash management or funding management or providing collateral to market participants. And those three aspects of the repo market is what we have done over the last years, in fact. And if you were asking me 5 years ago, it was pure cash management. In fact, the day-to-day business was sort of supported by the repo market and repo trades on our side. Since the purchase program, we use the repo market also to offer collateral to market participants to benefit from the yields in the repo market that market participants are willing to pay in order to sort of to get access to these bonds. And but this year in particular, 2022, we will also use the repo market to support our funding needs until year end. So tapping those 18 bonds was a reaction of having, on the one hand, observing that there is this need for collateral. Those 18 bonds are particularly expensive, are particularly demanded in the repo market. This is how we collected those 18 out of 80, 18 out of 80. They are sort of designed for supporting the Bund, the functioning of the Bund market, and they are designed to offer them in special repo trades until year end and until beginning of next year. And the cash amount that we get from there is either parked on our Bundesbank account, which is economically sensible as of today, since we get interest payments from the Bundesbank on this account, at least until end of April. And on the other hand, we can use this cash for, say, unplanned funding needs until year end due to sort of the support requirements for the energy crisis. As you know, the German government has set out a program for supporting the energy corporates, companies, but also to subsidize energy prices. And there is a certain funding need until year end, but also in 2023, also 2024 out of this. And this cash amount that we generate via the repo market is really a cushion to be able to sort of deal with those funding needs out of these additional programs, which in total size are not clear to us as of today, but it will become clear in October, in November. And for this, it's good to have such a flexible instrument in hand. So to summarize and answer your question, the reasoning behind this was to support the functioning of the Bund market on the one hand, and on the other hand, take advantage of the cash amounts that we generate with this to have a cushion for the uncertainties out of the funding needs stemming from the energy crisis.
Thanks, Tom, and thanks to all the panelists for helping to set the scene. Now, of course, all of you need end investors. So, Patrick, we're going to turn to you now. Maybe we could start with your view and your team's view on investing in fixed income at this time. Obviously, it's a double-edged sword. In the long term, high yields seem like a good thing, and the short term, falling prices doesn't seem like a terribly good thing. Where do you sit on when you're in the market and out of the market from that point of view?
Well, it's a very important question, and as you understand, many investors are a bit lost and don't know what they have to do. Can I have two remarks?
Please.
As an investor point of view, the bid and ask, you spoke about that. We used to analyze our cost of trading relatively to the yield level. So if you take into account the yield level, which was negative last year and now positive, the bid and ask for me is unchanged in relative terms. So for investor, it's not a question that one. What is the question, and that's to answer to your question, is that government bonds are less liquid. The size of the ticket is lower. So it means, first of all, asset allocation is not active. For 2 decades, government bonds were supposed to be a safe investment. They are supposed to be the investment when you have when you have a crisis. Today, every asset classes are down. So government bonds are not anymore the asset you're buying when there is something new. So that's a big change for investors. We expect it should be temporary. It's up to ECB rate adjustment, of course, but this is something new in the way we consider to invest in sovereign. And that's why when there is an auction, there is no natural buy of duration at any time. We have to prepare the auction. And as mentioned very well, Tamo, investors are not really, but it's not their job to fine tune the auction pricing, to hedge or not to hedge. It's a team job. Only a large asset manager could do that. So we are far from investing in the primary market. And of course, in the secondary market, we are more focused perhaps on what we call the high betas. Because today you invited 4 DMOs representing the most liquid debt. There are other countries in the Eurozone. There are Greece, but also Eastern countries, which have been impacted by the crisis, by Russian invasion. And the question raised by Tamo is different if you consider the different Eastern countries. The bid and ask is really an issue for this country, the size, of course. And as a portfolio manager, our first move for sovereign was to reduce for active management the part of these countries. We didn't change for the debt plus bonus, and we don't change. But for the others, yes, we change. Because if we like to actively manage our portfolio, we can't have the same holding on different countries, even belonging to the euro currency. I just would like to highlight, because I don't know if someone from investment bank is still there, but trading activity diminished for me significantly. Perhaps not for you, but of course for credit, for sub-sovereign, for Eastern countries. And when you buy some names, you don't know when you can resell. So we diminish our exposure in favor of cash. And I think most investors did the same. And the last issue for investors, but they are also focused on their own needs. And the main change when you have a big change in the rates, which was not expected a few months ago. At the start of the year, no one was expecting such a jump in inflation. Of course, the question for investors is that we are not comparable to UK pension fund, but we have also liabilities. And the liabilities were quite usually impacted by the raise in rates. So it means the liabilities diminish significantly compared to assets. And usually, the main buyers of government bonds are the long-term investor, pension fund, insurance company. And due to their liabilities diminishing quickly, they didn't buy duration. For the time being, they are stopped to buy duration. So mainly, currently, asset manager, active portfolio manager are buying government bonds, as you know, and we are perhaps active. What I notice, to come back what you said, Davide, the volumes are unchanged for the year. Every month on electronic platform for clients, for investors, for government, the volumes are unchanged. Even in June, even in September, despite the sell-off. So it's not the bid and ask, but it's showing to us what is the needs of investors. Finally, it's not the active part, but they didn't increase as they did in the past when there was a crisis. On the opposite side, there is a lack of foreigners due to the negative rates and low level of rates. Foreigners didn't buy. Japanese clients, when they bought euro currency and euro bonds, they bought credit. Now, the last perhaps main issue they bought, Davide, was BTP and bonus last year, but it's not necessarily a huge amount. So the sovereign market for investors was not the focus yet. We are more focused, as you mentioned, on the high yield, because the spread close to 6% is something which means a recession with default. And default should impact the activity, the governments. And today, for sovereign, the good news is that the first half of the year saw better fiscal tax revenues, thanks to growth, which is better, especially in the south. Of course, because of inflation. Everywhere we have better than expected public expense result. So perhaps it should change if we have an activity which move on the downside with more default, which is not yet the case.
So you're becoming both more liquidity sensitive and more credit sensitive at the same time, effectively.
Exactly. And when we consider to invest in sovereign bonds, it's more Eastern countries because it's a credit bet, of course, which not, but the good news, which is not the case at all for the usual high beta names. I would like to say that the south of Europe spread widen, but as a beta of the market, of the credit market, of the swap spread, there is no specific debt identified as at risk in the Eurozone. So that's why there are low volumes. Of course, bid and ask are perhaps higher, but relative to the yields level, for me, it's normal. And of course, the question for us is more the size of the ticket. The ticket, it means we can't move as we want. And of course, there is a premium, as mentioned Davide, on where you have derivatives. It's clearly important. Of course, it means increasing the daily volatility. But as a portfolio manager, our job is to take advantage of the market inefficiencies. So of course, we don't say we are unhappy with that. When we have active management, we take into account our liabilities. For asset manager, for funds, it means, as you understand, clients. And we have to have cash to face redemption. But you know, we have built in the Eurozone, all the funds have gates to authorize large redemption in case of. So for me, we don't expect this is a big issue. Perhaps what could highlight, but I'm not the expert, is the winding of the ask on the tracker ETF certain days. Not for government, but globally speaking, because of course you have to find liquidity at the closing of the market, which is for me not only the primary market, Tamo, but when you have a close of the market, you have some noise because you have to have a final adjustment of the liquidity from the seller or buyer bonds every day.
Yeah, interesting. I mean, Karen, your views on what Patrick said from an investor point of view. You know, you mentioned being creative. Maybe you could talk a little bit more about that creativity.
Well, it makes perfect sense what Patrick is saying, that from an investor point of view, this is how you, this is how you become creative. I don't know. I think most of what he said reflects good on us as an issuer. I mean, so the Netherlands, of course, is a much smaller issuer than the other three issuers on the table. So for liquidity is at least in theory a bigger problem for us than it is for the others. In practice, I think so far, what we've heard from investors is that so far there haven't been that many problems yet. I guess that is because pre-COVID we had a much smaller funding need even. So we always focused on being as simple as possible in our bonds. So having not many types of flavors around, so as to be able to have at least a decent size issuance within each bond. So we don't have inflation-linked bonds, which of course, I mean, maybe investors are not happy about that, but from an issuer's point of view, we're happy about that at the moment. We don't have ultra long bonds, which I guess face higher liquidity problems at the moment. And it's also like a particular type of flavor. I guess there are good reasons to go for it, but we never did it. So we want to be as boring perhaps as possible in order to serve the investors to help the investors from the liquidity point of view. And I hope that helps them out in the end. The credit. So I hope the Netherlands doesn't become a country where investors bet on from the credit point of view. That's what I'm saying.
Just before we move on to another thing, Patrick, in terms of, you've heard from some of the DMOs what they're doing to try to improve liquidity, and they're aware of it. Is there anything that you would ask them to do to help in that respect from your view as an investor?
I think what was mentioned by the different DMOs is to ensure a more efficient repo market. Because if you consider there is less trading activity from investment banks, less different numbers of banks, I think the repo is becoming more important, perhaps more tailorization of the repo to simplify as a portfolio manager, we don't do a repo. I think we have to work together to find something easier, more simple. Because of course, more you have different type of actors, more it should be liquid and efficient. Of course, as usual for investors and especially for global investors, it was our previous topic, to have a time schedule of a primary market. Syndication could be good news sometimes not. Of course, syndication, or if you remember last week, before there were rumors, Greece could issue a 7-year. You understand the syndication could be useful, but it should also create some volatility when the market is perhaps not so liquid. So perhaps syndication should be announced in advance, but it depends on the market condition, I know, as usual. So it's difficult. Sometimes we can say that it should be better to have more auction or more syndication and less amount per auction. Honestly, it's not simple. It's not simple to find a solution. As I was telling you, the question also is linked to the investor themselves. If investors are not focused on sovereign bonds, and that's the good news. This is the first crisis for a long. Euro sovereign is not the center of the crisis. So finally, it's a good point to notice. What I mentioned is also that there is a global picture which is linked to politicians and their program, the rescue plan. You have uncertainties coming from the cost of energy plan, from what we can do with all the disruption risk. So this is really a world of uncertainties, and the DMOs should fine-tune that, but they can't change. I think the most important issue we have today, I think, of course, especially for government, it's a relative question. What is the question how to make it to promote government bonds? I think for the Eurozone, there is no question today on that. The bonds are liquid. But per bonds, bonds are more liquid than some US bonds, as you know. And I'm not speaking about Japanese bond, etc. So there is no question. We can have a price on every bond. Of course, we should prefer to have smaller number of bonds with higher amount, which is what usually the investor ask. There are some issues, as you know. The last one, which was not expected, to have two different coupons. Because when we have some bonds, it was mentioned, the Austrian 1-century bond, but you have bonds with a price now, which is quite very low, because the yield jump from, and the coupon was 0.
Sure.
So we perhaps would like to propose, but we should have perhaps more exchange of bonds from the DMO when the bonds are out of the money for the coupon.
Okay. I just want to move on from that because we're going to run out of time very quickly in this discussion. There's so much to get through. Let's get to the market makers. We've got a lot of people on the line, I know, from the investment banking and capital markets community. Davide, it seems to me that interestingly, you are, as you said, you're adding primary dealers, having been through a period of time in most European markets where there have been banks exiting, which I think is interesting in itself, and it'd be worth just getting your views on why that might be. But what more can your market makers do? These are volatile markets. They are institutions that have to carry a lot of capital now. They don't expend their capital as fluently and fluidly as they did in the past. So what for the market makers listening in today, what might they do to help you?
Okay. Yeah, this is true. I mean, we had an increase of primary dealers recently, coming from the end of last year. I mean, our understanding is that, well, first of all, consider that according to our legislation, if a bank has a certain type of purpose, it is allowed to apply for becoming a primary dealers. And then if we have an evaluation period and it performs fine over this evaluation period, we have no reason not to accept as primary dealers. We see, however, an added value from this. First of all, in terms of having more dealers quoting on the secondary market. Of course, we are experiencing, as we said, periods of higher volatility and lower liquidity, but who knows what would happen in case these primary dealers would have not been there. On the other side, of course, they guarantee a wider participation in the primary market than in a period with higher financial needs is important, because we put a minimum threshold for participation on our auction of each primary dealers. So this is another important element. Thirdly, I would say Not in all cases, but in some cases, it's important to have a wider set of primary dealers because they can cover a larger set of investors, both in terms of type of investors, but I would say more in terms of geographical location of some of these investors. So that's for us is an extremely important element. So the more we're able to diversify a base of investors, the more we're able to carry out our funding program with less problem. And so these are all additional elements that I think have brought some help to us in this period. And I think they will be a good, say, market infrastructure for us also going forward in challenging year like it could be next few years. If I can add a couple of points on what Patrick was saying was extremely interesting. So from our perspective, it is true right now that we have a wider bid-offer spread, but higher rates. That's absolutely true. But in our experience, when you have the situation with higher volatility, so primary dealers tend to have wider bid-offer spread, but at the same time, wider bid-offer spread create more uncertainty in the market, and somehow they, in a sort of vicious cycle, tend to get even worse the situation of volatility in the market. And when there is more volatility, we know that because of VaR limits and so on, a lot of asset managers tend to reduce their exposure or tend to stay more on the sidelines. So that is why, in general, bid-ask spreads, independently from the level of rates, it's a very important aspect. Of course, we just don't look at the best bid-ask spread. We do some more thorough analysis, looking at all the order books that we have on the platforms. But I think that it's a very important element. The second point, and I want to come back, also what Patrick was saying, is regarding the importance of derivatives. As I was saying, for us, the future on BTP, it's important to provide an additional tool for hedging to primary dealers. However, this is a pro. There are also cons because, of course, we have also been experiencing, this is a very technical issue, so we will not enter into the details, but how the set of bonds being in the basket of the contract is set, what are the rules, and sometimes this has contributed to create some volatility regarding how the cheapest to deliver bonds materialize, and this is also due to some rule of the contract. So we hope that there will be some adjustment on this, because this has not helped liquidity. Liquidity, and also increased volatility in some issues. And the other point that I want to underlies the fact that our future contract is quite liquid, and for this reason is used also for many other hedging purposes. That's hedging Italian debt, which is hedging government debt, sovereign debt of other countries that are more correlated with Italian credit, but also hedging other type of risks. So unfortunately, this brings an element of volatility on our market, and so goes in the opposite direction versus the other one that I mentioned before, that instead is helping. So there are pros and cons with these instruments. We need to be very in my opinion, the way we judge these instruments.
Thank you, Davide. Cyril, I wonder if you could come in on that side of things, and also a little bit about the role of market makers and how you see them performing, and what else you'd like to. And then Karen, I'll come back to you. Thanks, Cyril.
Well, market makers are very important in our system because, I mean, our system is basically based on predictability, regularity, and being market neutral. But in the meantime, we have to be able to answer to market demand to actually implement this policy. And the interface and the way for us to access to market demand are primary dealers. So they are key to our system. This is what make it possible for us to right now basically keep unchanged our the main parameters of our system. So this way, we believe that in uncertain times, it's good to keep something stable in order not to add uncertainty to uncertainty. But in the meantime, we need to be able to answer to market demand. And so that this is what we are doing, and this is what is, for instance, guiding our choice of bonds to issue, and how, for instance, the duration of our issuance is evolving over time. And right now, which is consistent with what Patrick was saying regarding investor interest, the duration of our issuance is slightly lower this year than it was, for instance, last year. So primary dealers are extremely important. We now have 15 primary dealers. We have just renewed the primary dealership at the end of last year. It's a stable primary dealership. Now their role regarding liquidity. This is a very interesting and constant debate. We tend to believe that it's difficult to force them to provide liquidity, and so if the market is too volatile, if it's too risky, if it's too costly, it's better to adjust the bid offer to what is the reality of the market rather than to force false liquidity, because in a sense, what you are winning in terms of smaller bid offers, you are probably losing it in terms of volatility and overall willingness. That being said, we also know that sometimes you need to give incentive to people because if you are too lenient regarding bid offers, then when in times of stress, they get the habit of easily going out of the market, and then it's a little harder to come back. So what we are trying to do with the incentives that are given to primary dealers through the rankings, the way they are produced, is to balance both. Some flexibility so that the bid offers adjust to what is the reality of the market, while making sure that we don't have a kind of an historical effect where we have bid offers widening but never tightening again. So this is a way we try to approach this question. But once again, I want to underline how key the primary dealership is for our system.
Thanks, Cyril. You also have the carrot of syndications that can be quite helpful, I think, which you don't, Karen, but I know you wanted to come in on this.
Yes, I wanted to add to the importance of market making, and also our primary dealers are very important for our market functioning properly. We've struggled this year as well with how to with maintaining this balance, incentivizing the primary dealers, but also taking into account the market circumstances and working with them as partners, I'd say. And we are not actively active in our secondary market. So one of the few instruments that we have to influence the secondary market is our quotation obligation that we use. And there's an incentive company to that for our primary dealers. But we've seen very heterogeneous performance between our primary dealers. And we've struggled with setting the parameters right. We've changed it a couple of times during the year. And we're still debating on how we should do it next year, because we're not convinced that, I'm not saying not convinced, but we're really debating on the impact it has on liquidity and market performance. So we're really not so sure. So that's the difficult discussion we have. So I'm happy to hear how my colleagues think about that. Actually, one interesting thing which is probably not discussed often is, I think the labor market for traders is influencing this quite strongly. So we've seen primary dealers where they find it difficult to hire good traders, and it strongly impacts the market. So it's maybe something that's not often mentioned, but I think labor market issues influence the functioning of the financial markets in that sense.
So there's been a generation of early retiring traders. Is that what you think?
Or someone switch to hedge funds.
I'd like to talk a little bit about windows. And we've talked a bit about volatility, and we've talked about liquidity. But we've also talked about the windows of issuance are maybe getting smaller. At the same time, of course, as we have most governments with at least the same, if not growing, financing needs. You have the advent of Next Gen EU, a big beast borrower on the platform as well. How will you guys coordinate issuance? How much do you coordinate issuance, and will that have to become more of a pressing concern in the year ahead? Tamo, I could ask you to go first on that.
Coordinating with Germany is easy. We publish our funding calendar, which is a predominant part of our refinancing activities in December for the upcoming year. So it is for us important to sort of have a pattern together with France. It is a well-known pattern to all market participants. When France does its 10-year, 30-year bonds, and so Germany fits in that from that perspective. So there are traditions that function well, and we follow these traditions on the one hand, and on the other hand, we are very transparent on our auction calendar. And then we added syndicated transactions to our activities since 2020. We indicate the maturity, we indicate sort of the month or the quarter in advance. We have to rethink whether this really is an advantage to the benefit of market participants, whether this is really necessary. We have to rethink about this, since syndicates clearly play a minor role compared to auctions. And the advantage of syndicates is to be more flexible, not only for the issuer, but also for the investor. And therefore, going forward, we will rethink whether we are that concrete and definite when it comes to maturities, and when it comes to the syndicated to the month of the syndication. But apart from that, we continue on this pattern.
Thanks so much. I'd like to bring now Michael Haas from the Luxembourg State Treasury. Michael, we've been talking a lot about sort of very big issues. Now, you are the ultimate infrequent sovereign, I think, in Luxembourg, and therefore you will have the entire calendar window to choose from. But how are you approaching how you might access the market next year?
First of all, thank you very much for having invited us and being part of this discussion. As you mentioned, we are by far the less frequent issuer on the table. I think we have issued at all 19 billion, so 19 billion in the market. Normally, we go every 2 years, 1 to 2 years to the markets. We don't proceed via auctions. We only have syndications. We had the last issuance we had now in May, so we covered our funding needs for the year and even for the first half of next year. So for the moment, we are quite comfortable in managing our financing needs. You said we can choose our window of opportunity, which is not entirely right, because we always have to look at the calendar of the big issuers, because we always want to avoid to go out during a week where Germany, France, or the Dutch colleagues go to the market, because normally we are less liquid bonds than the big issuers, and liquidity for Luxembourg is an issue because we don't have a real secondary market. So we always pay attention to not cross our issuance with big issuers. So we are very thankful that the big countries publish their calendars in advance, so that we can adjust and find the right window of opportunity for small issuer with small ticket size.
Thank you, Michael. Let's talk a little bit about syndication. We talked about market makers from the point of view of dealing primary market. Syndications could become more important if markets are volatile. There's been fairly straightforward markets for launching syndicated bonds in for some time. I wonder whether the syndicate banks are all the same. They're sort of ready for this return to volatility, the risk taking that's involved in building a book, or whether it's been 15 years since this really existed, and maybe some of those skills has been lost a bit, like as you said, Karen, the traders have gone away. David, I don't know whether you'd have a view on that.
Okay. But I have to say, if the question is regarding the mix between the syndications and auctions, and the role of syndication in a more volatile market condition. I mean, in Italy, we have widened the role of syndication during the pandemic for the obvious reasons that we had to do much more funding in a much more limited time. And of course, syndication were quite useful in this respect. Already in 21 and 22, we have come back to more ordinary attitude to this issue. So we, of course, syndications are important, but they constitute a marginal part of our total funding over the year. And here I more or less say the same thing that Tamo was saying, but the bulk of our funding stays through auctions that are communicated well in advance, through a calendar that is specified on a day of the announcement, days of the auctions, days of the settlement. In December of the previous year, all the calendar of the following year is already well detailed, and on a quarterly basis, we also announce the bonds, the new bonds that will be auctioned in the following quarter. So this is our departure point. Now we'll see how things will evolve over next year. Actually, I'm not sure that syndications, increasing the role of syndication would be beneficial in volatile market context, because as we have seen also this year, sometimes finding the windows, as you said before, on in the market to allow for syndication, it tends to be much less easy in volatile market context. So for the time being, we don't see the reason to change the mix of these two way of accessing the primary market, which is both extremely important. But we still think that relying primarily on a calendarized and well-functioning auctions and pre-scheduled auctions is still the better choice for the time being. Then we'll see how the year will develop over the course of next months. But this is our standpoint now.
Thanks, David. And I suppose it's worth pointing out that you can always clear an auction if you're prepared to pay the price. I mean, we saw the UK actually do, I think, 4 billion sterling the day after the worst budget statement in history had been announced, and the markets were tanking, and they managed to go and raise the money. Cyril, talk us through your outlook for next year's issuance. Maybe also talk a little bit about, clearly investors seem to be more focused on the shorter end of the curve in these conditions, and the extent to which that might affect your ALM side and your debt profile as well, or how well you are prepared for that.
Well, turning to next year, we actually have already produced in the draft bill for 2023 what is our estimate for the funding needs for next year. And actually, they are stable in terms of overall funding need. And we are planning to issue 270 billion euro of OATs in net terms, so which is slightly higher than this year, which was 260. But since we also have 10 billion euro more of redemption next year, in terms of net access to the market, it's similar. We have not yet indicated how we are going to implement this. We have a process where right now in October, November, we gather advice from primary dealers, from investors, in order to decide what kind of principles are going to guide our issuance the following year. Notably, we announced all of the new lines that we intend to launch. So we still have to wait to see what will be next year. Last year, actually, we really were in a very uncertain situation, not knowing basically whether we were going to remain in a world of very low rates for longer, or whether we would have normalization. And as a result, actually, for the first time, we had included a syndication that could be a 20-year or could be a 30-year, depending of the scenarios the demand will take. And we went for the 20-year this year because we are in the normalization scenario and not in the Japanification scenario this year. Maybe one thing, since you mentioned ALM and duration, for us, the duration of the debt is really the result of what is market demand. We, as a result, have seen increase in duration. We now have an average maturity of the debt, which is above 8.5 years, while it was below 6 years before QE. What we expect is that that should stabilize and then gradually recede if we move back to the environment we were before QE. So that, but that will take time, and as a result, this ALM from a interest rate risk point of view, the fact that we have this quite large average maturity, but which is not unique to France. I mean, I guess that all issuers have more or less faced the same situation, given how demand had shifted in previous years. It gives us time to adjust to what might be the new yield environment.
Thank you. So, Tom, if I can come to you with a similar question around, your expectations for next year, where investors might focus, whether it might be at the shorter end of the curve, and what that means for your debt profile and ALM point of view.
Thanks. We publish our issuance calendar in December.
That was a good answer, Tamer. Patrick,
for Christmas.
For Christmas, yeah. Maybe we could get together on Christmas Eve, and you can tell us then, Tamer. That would be nice. Patrick, give us a positive feeling from an investor point of view to finish on today. It's quite easy in these difficult markets to get a little bit gloomy, but these issuers are going to remain cornerstones of every fixed income portfolio for the foreseeable future, aren't they?
The good news is that if you consider aggregate, not only government but credit bonds, you can reach easily 5%. So I expect it should move investors from their cash exposure, because the cash today, as you mentioned, what is strange for investors, not for professional perhaps, is that short-term investments are very volatile. If you are going to see a French or Italian banks and you show your short-term funds and the performance, we have the case in Italy, an example in Italy, no one expects such a loss on short-term funds. And on the opposite side, on the very long end of the curve, due perhaps to the fact that the market is convinced that the central banks are going to do the job against inflation, the long end of the curve is very volatile but outperform in relative terms. So to come back to the DMO, it's a really tough market condition where you can locate next year. Your insurance program is not really easy. I guess to come back to your question, that when we should normalize, when we should know what could be the normal rate, because today no central bank told us what is the neutral rate. I don't expect when you ask to some strategists, neutral rate, you should know after when you should start to cool the economy, which is not really a good outcome for next year and for Christmas. So you have to wait. So we can expect now we should be not too far in the Eurozone and perhaps also in the USA. I'm not speaking about the terminal rate. So this target should make again the short-term investment more rational than it was, especially for credit, because I'm coming back again. The spread jump also on the short-term maturities, the swap spread, the credit spread. So yes, it's a question of maturity. So I guess that if we have a new year, happy new year, we can consider that the asset liability management issue we had, especially in the UK but everywhere, should be clean. So we can expect investors to come back to the usual long-term investment, 15 to 20 years maturity. Perhaps the very long end of the curve was a trade during the QE time. The QE time push investors to buy the very long end of the curve, because you understand it's a convexity bet with the negative rates. I don't expect this trade to go on next year. So perhaps we should have a focus from investors, not on the 10 year, but the 15 to 20 years, which match the usual capex plan, the average life of people. So we should be the centerpiece, I think, of the primary market next year, and the short term to match the needs of some investors, because I don't expect next year to all the cash will be invested on bonds. The cash is there. There is a lot of cash, and this cash should buy safe investment. And safe investment perhaps should be short-term government bonds.
Thanks, Patrick. I'm going to finish with a question to each of the DMOs, for which I'd like a one-word answer. And part of the challenge here will be whether Tamo can say, "I'll tell you in December" in one word. But maybe starting with you, Cyril. Do you expect that your funding needs will go up because you will need to provide continued support because of the energy crisis? Yes or no?
I mean, as I indicated, we have already published our funding needs for 2023. So,
okay, but those might change, I guess, right?
Well, what we tend to do, I mean, funding needs can change. You can have more needs or less needs. Actually, for instance, in 2020, we first had a large increase in our funding needs, and then it happened that we actually didn't need all of what we had raised. And so as a result, we actually are funding this year, notably with part of what we raised in 2020. So that can change. But our policy is usually, when we are talking about medium and long-term issuance, to be as stable as possible in order to be predictable once again. And so when we are facing with sudden needs, funding needs, our first line of defense is the increase of short-term debt. We have also added a new line of defense, like the possibility, like my colleagues, to access the repo market in case we have urgent funding needs. So we have a set of line of defense so that we can face funding needs if they happen, without having to rely to the medium and long-term market, where we think that it's important to give predictability. That being said, when, like in 2020, the market circumstances make it possible to revise up the medium and long-term program without upsetting expectations, then we did it, and so we did it in 2020. But my answer would be, we want to be predictable, so our announcements tends to be implemented.
Understood, Cyril. Davide, I heard from a reliable source that the gas storage facilities in Italy were full. So maybe your answer to my question is no.
Okay. I have to say I'm very much tempted to answer like Tamo. And we have even a wider reason for that, because we have just changed government, and of course the discussions regarding fiscal policy has just started with already with the implication for our funding for next year. What I can tell you is that next year we're going to have more redemption to refinance than this year, so this will definitely have an impact on our total funding in bonds, which will be higher than this year. When it comes to, you said correctly that the situation in terms of energy crisis and the relative intervention from the government is quite under control in terms of availability of energy sources, but a different story, of course, is the price that we're gonna pay for that. But again, this is really too early. We need to see how the situation evolve, and also from our side in December we will have a more clear ideas. However, we have quite a wide set of instruments available, and this wide range of instruments is also being set in order to cope with different type of macroeconomic shocks, and also we are working to further diversify our base of investors. By the way, when we were talking about the level of rates that Patrick was mentioning, we are seeing quite a relevant interest coming back from the retail community, for example, that seems to be very interesting in buying traditional bonds, and also the bonds that we tailored to retail investors. And on the other side, of course, we are expecting to receive the loans from NGU, which will represent another important source of coverage. And finally, as also Cyril was saying, we have our repo facility that is a very brilliant system for optimize our cash management and also to cope with the periods where there is more temporary, of course, cash needs, and allow us to place, for example, syndications in the right timing. And so this is a very useful instrument to provide us more flexibility. So it's going to be definitely a challenging year, but considering all the different elements, looks quite manageable.
If you leave it on, then we can just pass the microphone to Karen. Sorry.
Thank you. I don't think I can answer in one word because my colleagues also haven't done it. So I feel the privilege and the freedom to not use one word. We don't know yet. So on the 16th of December, we'll publish our outlook for next year. I can tell you that the Dutch government announced a big subsidy on energy prices that's open-ended. And the government also did not announce how it will be covered yet. So there's two sources of uncertainty there on the funding need. So that and on that side, it's probably likely that the funding need will increase because of the energy package. On the other hand, as I said before, last couple of years, we've always had the experience of overfunding from the beginning of the year. So that's perhaps directs to being a bit more re-estimate the funding need downwards from the beginning rather than and then maybe increasing over time if it's necessary rather than decreasing. So that points to the other direction. So we'll see. We're debating at the moment what we'll do.
Thanks, Karen. Final word, Tamer.
Yeah, on the one hand, we will have a structurally balanced household 2023 and the years thereafter, which means that the deficit we need to fund is going to be significantly smaller than this year's deficit, for instance. On the other hand, we have extra households to be financed. One was already mentioned, our expenditures on defense will increase, and also the subsidies for energy and support for the energy companies needs funding in 2023, and therefore the overall picture is mixed. Yeah, I would say I don't expect a smaller funding need in 23 than in 22.
Thank you, Tamo, and thank you to all of our panelists just now, and to all of the speakers during the day, and to everybody who's joined us. There's a lot to talk about. I feel like we've scratched the surface, and I'm sure we'll want to convene this group again in the near future, maybe after December, so we can talk in some concrete terms. But this is, it is a difficult, challenging time for everybody in the market. I applaud the DMOs and the issues that are here today for their professionalism and, as I say, their unflappable nature in getting a vital job done. It's worth remembering that our economies don't function without the work that DMOs do. And thank you to all of you for your honesty and spirit of cooperation. We look forward to doing this again very soon. And thank you again to our friends and partners at DZ Bank and Luxembourg for Finance for their support today. Thank you all for joining us online, and we'll see you again soon.
Thank you.